program on which Templeton appeared. Templeton was, by common repute, one of the most successful and best-known professional investors of the past 100 years, as well as an outstanding philanthropist. Knighted by the Queen of the United Kingdom in 1987 for his many years of charitable work. Forbes magazine dubbed him the Dean of Global Investing, in recognition of the trail he blazed in seeking to invest across the world when others were too afraid to do so. Louis Rukeyser, host of Wall Street Week, a popular network television program on which Templeton appeared many times, said that this quiet, deeply religious man was one of the genuine heroes of Wall Street. Prem Watsa, a Canadian fund manager, described Templeton more recently as a wonderful man and, for all practical purposes, perhaps the greatest investor of all time. The detailed research we publish in this book confirms that John Templeton was indeed one of the very few professionals who can rightly claim, hand on heart, to have consistently obtained the holy grail of stock market investment, above-average returns with below-average risk. In his case, this was a record that he sustained for the best part of half a century. His best-known mutual fund, the Templeton Growth Fund, never once in 38 years under his guidance failed to deliver a positive, real, inflation-adjusted return over any 60-month period. This is a record that only a handful of other professional investors can claim to have achieved over such a long period. 4 years after his death, Templeton's name and investment philosophy live on around the world through a wide range of funds that either carry the Templeton name or claim to use his methods. Many billions of investors' money is today managed on the basis of the simple but profound principles first laid down by a man who stands comparison with Warren Buffett, George Soros, Peter Lynch, and a handful of others as one of the all-time greats of the modern investment world. The reason for this enduring legacy is simple. His investment methods have stood the test of time. They work. And in this book, timed to coincide with the 100th anniversary of his birth, we set out to explain what those methods were, the truth about his track record as an investor — there are a number of surprising myths — and why and how his methods continue to be relevant today. Given how many words have been written already on the subject, it is legitimate to inquire whether the world needs a further book on the Templeton approach to investment. We asked ourselves the same question when we originally considered embarking on this project. Amazon, the online bookseller, lists no fewer than 50 books, for example, about Templeton's life, investment approach, and spiritual concerns. We came to the conclusion, however, that there is still room in the market for a single-volume, independent assessment of Templeton's investment methods and philosophy, written from a professional rather than a religious, philanthropic, or family perspective, and with the future, not the past, in mind. These are the main reasons why we believe that a single-volume study that seeks to encapsulate the essence of John Templeton's investment wisdom is both fresh and timely. Number 1. A fresh perspective. Some of the many books published about Templeton's life and methods in the past have verged, we think it is fair to say, on hagiography. Many seem to have been written to advance his philanthropic and religious interests rather than primarily to enlighten investors. Others are either out of print or sponsored works by close associates, published with the assistance of one of Sir John's charitable foundations. This one, in contrast, aspires to be an independent and objective contemporary assessment by 2 investment professionals with many years of direct experience in the investment business. The 10 years that one of the authors, Sandy Nairn, spent working directly for Sir John have given us additional first-hand insights into what his approach to investment means in practice. Number 2. Access to new material. We are fortunate to have had access to a considerable amount of previously unpublished information. This includes copies of the letters that Sir John wrote to his investors and clients over the course of 50 years, as well as detailed data and analysis of his performance record that have not been professionally published before. In 1993, Mark Holowesko, then Chief Investment Officer of Templeton's fund management business, began the practice of circulating around the offices of the Franklin Templeton Group copies of internal memos and letters the firm's founder had written in the past. They proved popular with the firm's employees and remain an invaluable source of insight into his thinking. We reproduce some extracts in the body of this audiobook as well as in the appendix. As with the essays of Warren Buffett, the clarity and insights that characterize Templeton's writings instruct as well today as they did at the date of origin. Number 3. Timeless Lessons. Sir John's philosophy of investing, which is built around the presumption that investors must have the courage and patience to ride out economic and market cycles and stick to a rigid investment discipline, remains highly relevant today. Twice already this century, from 2000 to 2003, and again from 2007 to 2009, investors have experienced savage bear markets in which stock markets around the world have fallen, peak to trough, by around 50%. Many investors remain shell-shocked and disillusioned by the losses they have incurred as a result. Had they followed a disciplined Templeton approach, we can show that they would not have fared nearly as badly as many did. Nor, we can say with confidence, would they have become so disheartened. John Templeton was an optimist by temperament, but like many great investors, saved his best investment performance for bear markets, underlining the fact that success in investment is just as much about avoiding losses and preserving what you have gained as it is about picking winners. Number 4. Methods that work. Sir John's track record as an investor, as we have noted, is remarkable not just for the consistent returns that he produced for his clients and fund investors, but also for their below-average risk. $10,000 invested in the Templeton Growth Fund, his first mutual fund, at its launch in 1954, would have grown to $1,736,100, 38 years later. The fund outperformed the equity market for 4 decades at a compounding rate of more than 3.7% per annum. In investment terms, where investment genius is typically measured in fractions of a percentage point of superiority against the market averages, this margin of outperformance constitutes a genuinely extraordinary track record. Standard financial theory holds that such a sustained period of outperformance can only have been achieved by luck or by the fund manager taking additional risk. Yet, as we will demonstrate, the fact is that the Templeton Growth Fund produced its exceptional performance with less, rather than more, risk than the average fund. As a value investor, John Templeton's approach to markets was rooted in the simple but powerful idea that buying assets for less than they are worth is the most certain and the least risky path to superior investment returns. We demonstrate with original research why these methods do indeed work, why they are so often misunderstood, and why so many investors in practice fail to take advantage of them. Number 5. Current opportunities. We believe it is important for investors today to appreciate that the events of the past 10 years that encompass the Internet bubble and its consequences, the tragic drama of 9/11 and the Iraq War, as well as the great global financial crisis of 2008 and its aftermath, reinforce the importance of some fundamental truths about investment. One is that there are always opportunities to make money, even when the outlook appears particularly gloomy. One of Sir John's favorite maxims was that the time to invest is at the point of maximum pessimism. Despite, or perhaps because of, having lived through the Great Depression during his formative years, he himself, by virtue of his temperament and personal faith, retained an unshakable faith in the capacity of mankind to rise above adversity, which he was confident would, in due course, be translated into attractive investment returns. In the final part of this audiobook, we look at where some of the best long-term opportunities now appear to lie. Number 6. Morally defensible investing. After the collapse of Enron, the uncovering of Bernie Madoff's vast Ponzi scheme, and the excesses of bankers during the recent credit crisis, investors' faith in the institutions that look after their money has been badly shaken. John Templeton's life and career is a timely reminder that success on Wall Street, in the City of London, and in other financial centers can be achieved without sacrificing the old-fashioned virtues of courage, honesty, and integrity that now appear to be so regularly and so blatantly disregarded in the financial industry. Throughout his professional career, initially as an investment counselor and later as a fund manager, Templeton demanded and set the highest professional standards. As a matter of personal habit, he was invariably punctual, courteous, and polite. And in a business career spanning more than 60 years, he took comfort in never having been sued, and in never, knowingly at least, having made an enemy. Number 7. An inspirational life. It is important, finally, not to lose sight of the fact that John Templeton's life and career are evidence of the importance of personal commitment and endurance in the face of adversity. The young man from Winchester, Tennessee, had to overcome many obstacles and setbacks on the way to acquiring the exalted reputation and wealth of his later years. When he was an undergraduate, at the height of the Great Depression, his father told him that he could no longer afford to finance his university education. Templeton was forced to scratch around to find the means to pay his own way and complete his education. 23 years later, his first wife was tragically killed in a motor accident, leaving him for several years alone with 3 young children to bring up on his own. Although his greatest financial success came only after the age at which many people have retired, his story remains an inspiration to anyone who wants to believe that it is possible to become wealthy and lead a fulfilling life at the same time. The year 2012 marks the 100th anniversary of Sir John Templeton's birth. He was 42 years old when he launched the Templeton Growth Fund, his first mutual fund, and the vehicle that was eventually to make him both fabulously wealthy and internationally famous. When the fund was launched, he had already been an investment counselor for 16 years, one known to his clients as a shrewd and sensible advisor, but still relatively unknown to the wider investing public. Whereas today there are thousands of funds in which investors can choose to place their money, in 1954 the new fund was a genuine innovation, being one of the first of its kind to offer insular North American investors exposure to a diversified portfolio of non-U.S. stocks within a tax-efficient mutual fund structure. Having sold his original investment advisory business in the early 1960s, Sir John was directly responsible for the management of the Templeton Growth Fund from its launch until he and his partners sold the Templeton Fund Management business to Franklin Resources in 1992, by which time its assets under management had grown to $21.3 billion. In 1987, he handed over day-to-day responsibility for stock selection to his assistant, Mark Holowesko, but retained a watching brief over the portfolio. 20 years after he sold and retired from the business that he had created, the Templeton Growth Fund and its many offshoots remain among the world's largest equity funds. The family of emerging market funds that John Templeton set up in 1987, in another of his far-sighted business decisions, alone accounted for $40 billion of assets under management in 2011. The track record of the fund's management team, led by Dr. Mark Mobius, has demonstrated the efficacy of his mentor's methods. In the 10 years to November 2011, the original Templeton Emerging Markets Investment Trust has outperformed its Morningstar benchmark by 4.3% per annum. The net asset value of the EP Global Investment Trust managed by one of the authors, has similarly outperformed the MSCI World Index by 3.3% per annum since its launch in December 2003. After his retirement from the fund management business, Sir John devoted most of his time for the rest of his life to his philanthropic and religious work. His primary focus in the later years of his life became his Christian faith and the affairs of the Templeton Foundation, whose endowments he continued to watch over with an eagle eye. Funded by his considerable personal fortune, the foundation gives away more than $50 million per annum in grants, gifts, and other forms of financial assistance. It continues to fund an annual prize to reward those who have pioneered scientific research into spiritual phenomena. The Templeton Press has published scores of books and articles that emphasize the importance of spiritual development. While his faith was a central part of his life, his religion plays only a tangential part in this book, which deliberately focuses solely on his investment career and beliefs. Right up until his death at the age of 95, Sir John continued to study investment trends and followed financial events around the world with an unswerving attention to detail. His eye for a bargain remained as keen as ever. During one of our conversations in the initial research for this book, we mentioned the fact that some privately owned businesses in the United Kingdom were then selling very cheaply, at 2 to 3 times earnings. "Gee," he replied, quick as a flash, "I would be interested in hearing more about those. Can you send me some details?" He was 91 at the time. At the same time, his sense of the many risks confronting the world remained acute. As early as 2003, for example, he was expressing his concern to us about the bubble that was developing in the property market on both sides of the Atlantic. This was fully 4 years before the subprime mortgage crisis was to send the housing market in the United States into a tailspin and the world financial system into its worst crisis for more than 70 years. This crisis was one that John Templeton publicly identified in advance. Just as 20 years earlier he had correctly and publicly forecast both the onset of the great stock market boom of the 1980s and 1990s and the investment potential of emerging markets. Such global awareness was one of the key factors behind his impressive track record as an investment advisor and fund manager, and the reason that his public pronouncements were so widely followed for so many years. The purpose of this book is to explain, as clearly as we can, the lessons and implications that we believe can be drawn from Sir John Templeton's life, experience, and investment wisdom. As such, it is not a biography, nor is it simply an analysis of what he said and did, although the book inevitably has elements of both. We would like to think of it more as a handbook for those who are interested in understanding and applying the philosophy of investment that John Templeton developed and practiced for so many years. Such an understanding is relevant to both private and professional investors, from whatever part of the globe they come. Because he spoke so much sense and had an uncanny ability to express himself in simple language, it has proved impossible not to quote liberally from his own writings and observations. The book is structured as follows. Chapter 1 reviews the story of John Templeton's life and career. This has been told many times, but we are able to add some new detail, correct one or two myths, and draw on original interviews with a number of those who worked closely with him. Chapter 2 provides fresh insight into the way that Templeton, in the first stage of his professional career, operated as an investment counselor, quoting liberally from previously unpublished letters to clients and memoranda to his colleagues. In Chapter 3, we look in detail at the track record of the Templeton Growth Fund and attempt to answer the question, just how good was he as a fund manager? We also analyze when and under which conditions his fund achieved its outperformance. Chapter 4 returns to the main themes of his investment philosophy and how he applied them. We look at the difficulties and challenges of applying his investment philosophy and process in practice, contrasting the way that he went about his decision-making with that adopted by most investors. In Chapter 5, we demonstrate, with the help of an exhaustive proprietary study of market behavior in 35 countries, why his particular analytical methods were, and remain, conducive to producing superior long-term returns. In Chapter 6, we summarize our conclusions and look back at recent market experience, attempting to interpret what has happened from a Templeton-esque perspective. We conclude with an assessment of the investment opportunities and threats that face investors today. The appendix contains a selection of memos written by John Templeton that we think will be of interest to the student of his methods and beliefs. Other memos from the same source, which we do not include, can be found on the Independent Investor website, www.independent-investor.com/Templeton-memos. The idea for this book was not his, and Sir John did not, sadly, live to review our manuscript. Although he gave the project his blessing and encouraged us to speak to his associates, this is not an officially authorized account of his life and methods. It may be worth emphasizing that we have neither sought nor received any financial support from either his family or his foundation. We are grateful, however, to the executors of his estate for permission to quote from his memoranda and letters, and to all those who agreed to speak to us about their experiences working with him. All matters of interpretation remain our responsibility. In particular, we would emphasize that in the final section of the book, where we examine the current outlook for investors from a Templeton perspective, the views are of necessity our own, rather than his or those of the Franklin Templeton Group. For stylistic reasons, we have found it easier to refer throughout the book to our subject either as John Templeton or simply Templeton, and only exceptionally as Sir John, the honorary knighthood bestowed on him in his 70s. We are open to receiving comments and other source material from those who worked with this great investor during his life, and will endeavor to incorporate them in future editions. Jonathan Davis, Alistair Nairn, London and Edinburgh, December 2011. Chapter 1. The Man and His Life. The story of how a precocious young man from Winchester, Tennessee, grew up to become one of the most respected and wealthy professional investors of all time has been told many times, so much so that, as with many rich and successful men, Discovering where the legend and the truth diverge is not always straightforward. John Templeton was a man of the highest personal integrity, but some of the stories about his rise to fame and fortune have, one suspects, lost something in the telling over the years. To judge by some of the conflicting details in different accounts of his life, certain facts have, with the passage of time, been either gilded for the benefit of effect, forgotten, or mixed up with one another. It is generally true that hindsight tends to make an individual's path to success appear smoother and more certain than, in reality, it was at the time. There is no doubt that John Templeton himself was fully aware of the importance of storytelling in building and sustaining an aura around his life and business success. Although shy by nature, he was an accomplished user of the media to advance his business career. A tireless publisher of books about his investment ideas and religious and philanthropic interests, and as a man, for all his genuine humility, not wholly immune to a certain amount of vanity. He had a sense of humor, but was not the kind of man to tell jokes. Yet there is no gainsaying the extent of his achievements or his remarkable record as a pioneer and exponent of the art of disciplined investment, an art he practiced and sustained over more than 3 generations. What is not in doubt is that, rather like Warren Buffett, another of the 20th century's greatest investors, John Templeton was brought up with an unshakable determination to succeed. His self-assurance, allied to an unrelenting capacity for hard work and the ability to reduce complex analytical issues into a framework of simple but reliable heuristics, was instrumental in enabling his later triumphs as a professional investor. Determination and self-assurance were etched into his character from an early age. As a young boy, encouraged by his parents to be resilient and to show initiative, he showed a keen interest in enterprise. At the age of 8, according to one of his earliest biographers, he was ordering fireworks from a manufacturer and selling them to other boys at his school for profit. As a teenager, unable to afford a car, he cannibalized the parts of 2 wrecked Fords, bought for $10 each, to create one vehicle in which he was able to drive himself and his friends around for the next 4 years before selling it at a profit. When his school was unable to offer him the math instruction he needed to get into Yale, his chosen university, he persuaded the head teacher to allow him to teach an extra class in geometry and trigonometry himself, learning as he went along and ending, perhaps unsurprisingly, with the highest marks in the exam. His drive to succeed faced its most severe test in the grim Great Depression year of 1931, when his father had to tell him that he could no longer support him in his undergraduate studies at Yale. The 19-year-old Templeton, by then in the second year of an undergraduate degree course in economics, had suddenly to find other ways to finance his studies. Recalling this early crisis many years later, he said, "At the beginning of sophomore year," which was 2 years after the great stock market crash in 1929, "my father told me with regret that he could not contribute even $1 more to my education. At first this seemed to be a tragedy, but now looking back, it was the best thing that could have happened. It caused me to begin studying really hard to get top grades and thereby maintain 2 scholarships to help with the expenses." It also impressed on him that hard work and self-reliance were the keys to survival in life. "Seeming tragedy can be God's way of educating His children," he observed later. "Mother had saved a little cash from selling vegetables and eggs, and I borrowed $200 from my Uncle Watson, which Mother paid back years later. This enabled me to travel to New Haven and to apply to the very well-organized Yale Bureau of Student Employment, which was run by a capable man named Ogden Miller, who later became headmaster at the Gunnery School. He helped me to get scholarships and also to earn money at various jobs, such as being senior aide of Pearson College and chairman of the Yale Banner and Potpourri yearbook." In addition to these worthy endeavors, Templeton took to playing poker with his fellow students to make up the shortfall in his funding, this despite the fact that in his later professional life he was to bar his colleagues from investing in gaming stocks as well as tobacco and drinks companies on ethical grounds. Templeton estimated that he managed to earn enough from the poker table, using his knowledge of probability and his native quick wits, to pay for 25% of his fees. His remaining financial needs were met by a combination of the loan from his uncle, scholarships, and jobs at the university. His time at Yale also saw him make his first stock market investment. As a senior at Yale, he told his colleague and biographer Robert Herman, I earned $1,000 as the first senior aide of Pearson College. That was a tremendous help because it covered one half of all that year's expenses. When the 1934 accounting for the Yale yearbook was finished, about $800 in profit was distributed to me as chairman and was used to open an account with my roommate, Jack Green. He was then senior partner of a stock brokerage firm in Dayton, Ohio, called Green & Ladd because his father had died during Jack's junior year at Yale. This account is now 42 years old, but the name of the firm has changed to Cowan & Company. My first purchase of any stock was the $700 preferred stock of Standard Gas and Electric Company, which was selling at 12% of par because of the Great Depression. From that original $800 and later savings have grown all of the investments I now own. By this time, Templeton had already decided that he wanted to go into the investment business. After majoring in economics and collecting his degree from Yale in 1934, he won a Rhodes Scholarship to Oxford to study law for 2 years. At this most prestigious of English universities, he was taught by a law don at Balliol College, there being at that date no specialist tutors in business, let alone the lesser subject of finance. The idea that investment might become a distinct academic discipline was still many years in the future. Benjamin Graham's seminal textbook, Security Analysis, written with David Dodd, had been published in 1934, but John Burr Williams's Theory of Investment Value, another landmark in the development of financial analysis, did not appear until 1938, having originally been written as a thesis at Harvard University. Although he had certainly read Graham's Security Analysis, which he later described as the best book ever written on investment, we do not know whether Templeton was familiar with the writings of John Maynard Keynes, whose most influential work, his General Theory of Employment, Interest, and Money, was published in England during the 23-year-old Rhodes Scholar's final year at Oxford. The General Theory contains some of the most famous passages ever written about the practice of investment, but if Templeton did read it, it seems that the world's most widely quoted economist failed to leave much of an impression. We have failed to find a single line of Keynes or any reference to him in any of the scores of memoranda, articles, or press interviews in the Templeton archives. Having finished his studies at Oxford and before returning to New York to start his career, Templeton decided to take 7 months to travel across Europe and Asia on a shoestring budget with a university friend, James Inksetter. During the course of this trip, he and his companion visited no fewer than 27 countries, observing the rise of Hitler at the Berlin Olympics and acquiring early experience of the world outside the United States. This experience was to stand him in good stead in his later career as an exponent of global investing, of which he was to become such a prominent pioneer. There were few countries with significant stock markets that he had not visited before he set up shop as an investment counselor, a discipline in which his knowledge and experience of other cultures and economies was evident from an early stage. The countries he visited for the first time included India, China, and Japan. In his own words, I finished Yale in summer 1934, so I was in Oxford for 2 years after that. Oxford, I found, was so different from American universities. They gave me 6 weeks holiday at Easter and 6 weeks holiday at Christmas, and we Americans there took full advantage of that. I spent the second 6 weeks learning all I could about Germany, including listening to Hitler. I didn't meet him, but I did listen to him. It was a build-up to war, but it didn't really involve America until Hitler invaded France. Many years later, Templeton returned to Oxford to found Templeton College, the first college in the university to be devoted to full-time management education. Into the investment business. The first job that Templeton found on his return to the United States was as a trainee at Fenner & Bean, a stock brokerage that was later absorbed into Merrill Lynch. After only 3 months, he was offered a much better paid job as treasurer at an industrial company, which sent him to Chicago, Dallas, and then back to New York. 2 years later, age 26, and by now married, he was ready to take the plunge and leave his job to set up his own investment advisory firm, which had long been his ambition. He later acquired the business of an elderly investment advisor in New York for $5,000 and set up office in the newly completed Art Deco skyscraper Radio City, now better known as Rockefeller Center. The purchase of the business was funded in part by a $10,000 loan from his former boss at Fenner & Bean. The loan was repaid after a year. It was the only time in his life that Templeton, who abhorred debt and strongly advised against its use for stock market speculation, says he had been seriously in debt to anyone. The loan from his uncle that helped him to complete his studies at Yale was, as we have seen, later repaid by his mother. Templeton's own account of his earliest professional experience is as follows. 3 months after I went to Merrill Lynch, one of my first mates was a Rhodes Scholar at Oxford, who said that he was vice president of an oil exploration company, and they had an opening for a treasurer. They offered me more than double what Merrill Lynch was paying me, and I thought I needed practical experience in how corporations operate, so I resigned from Merrill Lynch and was shifted by this exploration company, first to Chicago and then to Dallas and then back to New York. That took a little over 3 years. At the end of 3 years, I owned some shares in my employer. I bought out the shares, which they helped me buy, and that gave me enough money to live for 5 years without income. The truth is that I started out my life with no money whatever. I made my own way through Yale and with scholarships through Oxford. This was true, although it would not be strictly correct to say that he came from a poor family. As he noted, once he had decided to set up his own firm, Templeton was not, in the early years, always able to draw a salary. 2 years after acquiring the first investment counseling business and getting his name above the door for the first time, he merged it with another larger firm to create a new firm, Templeton, Dobro & Vance, in which he retained a substantial majority shareholding. Given his other commitments, it was perhaps just as well that the frugality for which he was to become well known was already much in evidence. He and his first wife, Judith Dudley Folk, whom he had married in 1937 after a 3-year engagement, vigorously embraced thrift as a way of life, furnishing their house with second-hand furniture bought at auction. She found a job in advertising, and together they made a pledge to save, as a matter of policy, half of their joint incomes every month. There are once again parallels with Warren Buffett, one of many successful investors for whom thrift is, or has become, an ingrained habit. To make thrift a joy rather than a burden, we made a game of it by telling our plan to all friends and relatives, who then gave us ideas. We found a furnished Manhattan apartment with a view of the East River for $50 monthly. Our friends helped us find blue plate dinners in restaurants for 50 cents. In 1940, the only Manhattan apartment we could find for $50 was on the 6th floor of a no-elevator building on East 88th Street. To furnish 5 rooms, we could budget only $25. Our friends watched newspapers for furniture auctions when people were moving away. At such auctions, if anyone bid $1 for a chair, we said nothing, but if no one bid, we said 10 cents. Our costliest purchase was $5 for a $200 sofa bed, which was so good we used it for 25 years. With such joyous games, as Templeton described this self-imposed frugality, he and his wife furnished the apartment within the $25 budget. His tightness with money is a recurring theme in all his future professional colleagues' accounts of their time working with him. A stock market coup. A second important episode in the Templeton story is that his first serious step as an investor was to decide, in 1939, just as World War II was breaking out, to go out and buy, sight unseen, all the stocks on the big board of the New York Stock Exchange that were priced at $1 or less. There are different versions of this story in print, but in the one that reads best, he even declined his broker's offer to give him the names of the stocks he was buying. His argument was that the stock market was due for a recovery, and that even the most uncompetitive companies were likely to do well on the back of the stimulus provided by the inevitable increase in government spending that would be necessitated by the outbreak of war. So sure of his thesis was he that he did not even need to know the names of the stocks he was buying. Templeton himself recalled this extraordinary stock market foray many years later. The very day that happened, the German invasion of Poland, I said to myself that if there's ever a time when corporations that are struggling come back to life is during a war. Following the Great Depression, there were more than 100 stocks on the New York Stock Exchange that had gone down to less than $1 a share, so I called up Merrill Lynch and said, "Buy me $100 of everything below $1 a share." That proved to be very lucky. Within 4 years, I had 4 times my money. It is perhaps open to later generations to doubt whether this simple account of nerveless, youthful investment genius was quite the whole story. Throughout his life, Templeton was renowned for the thoroughness of his research, and indeed it was his study of previous episodes in financial history that had led him to conclude that low-priced stocks were likely to do better during the kind of wartime stock market recovery that he was expecting. It seems implausible, given the scale and audacity of the speculative investment that he was making, that he was not fully aware of the names of many, if not all, of the stocks he had instructed his broker to buy. Further, it is not wholly convincing that he made his decision entirely on the spur of the moment, the very day that Hitler invaded Poland, as his later telling of the story seems to imply. It is worth recalling, too, that in today's money, the $10,000 investment would be the equivalent of more than $150,000. Such a sum was many times the average income of the average American citizen, and twice the amount Templeton himself was about to pay to establish a foothold in the investment counseling business. For a young man of 27, it was certainly an audacious move, not least because it was effectively funded with debt, in the form of the $10,000 loan he had earlier taken out from his former boss in stockbroking. No fewer than 37 of the 104 stocks that the brokers acquired on his behalf were already in bankruptcy. It is tempting to say that few investments could have been more speculative or less typical of the disciplined methods that Templeton was to advise others to pursue in his later career. Although he was to become renowned in his later career as a long-term investor who never failed to extol the virtues of patience and an even temperament, it is fascinating to speculate how much equanimity in practice a young married man, even one as self-confident as Templeton, was able to muster as he waited for his massive, speculative gamble to play out. Did doubts enter his mind at any point during the 4 years he held onto his portfolio of third- and fourth-rate stocks? It is worth remembering that his investment decision was, not for the first time in his career, well ahead of events. His $10,000 purchase of stocks was made more than 2 years before the Japanese raid on Pearl Harbor, which was the trigger for President Roosevelt to take the Americans into the war, something many of the allies on the other side of the Atlantic, from Winston Churchill down, were far from convinced was going to happen. If, as he later recalled, the $10,000 loan was repaid within a year, it seems unlikely that this could have been solely the result of any rapid increase in the value of his stock portfolio. Although the price of stocks on Wall Street rose on the day that Germany invaded Poland, and again the day afterward, they did not break out decisively above their level on September 3, 1939, for more than 3 years. The Dow Jones Index fell by 12.7% in 1940, and by 15.4% in 1941. It was not until April 1942, 5 months after Pearl Harbor, that the stock market finally began the significant wartime rally that Templeton said that he was expecting to follow the outbreak of war. The index did not surpass its level on the day Britain declared war on Germany until after the invasion of Normandy in June 1944. 4 years on from his original purchase, on September 1, 1943, the Dow Jones Industrial Average was less than 2% higher than it had been on the day he made his first investment. Of course, many individual stocks fared much better than the average. There were good reasons for believing that near-bankrupt companies would fare better than the averages. for his portfolio to rise by 100% in 12 months in a flat market and by 300% over 4 years, as his account suggests, was therefore a remarkable achievement. A more realistic assessment may be that his analysis, as was true so often in his career, was correct, but that his decision to invest was some years ahead of events. The outbreak of World War I had been followed by a surge in the American stock market, but after an initial 2-day rise, this was not what happened in 1939. The assumption was wrong. Many years later, in a letter to his clients, Templeton noted how many weak or failing companies had subsequently produced exceptional results. Wartime saved many companies that otherwise might not have survived. The worse their balance sheets were, the more leverage they enjoyed. More than 200 companies had risen by 20-fold or more in the previous 20 years. Yet it is notable that most of these companies had experienced their lows in 1941, not in 1938. In other words, while Templeton was vindicated by later events, the timing of his speculative foray, so different from his later investment style, was distinctly premature. Investment Counselor. Recalling his early days as an investment counselor in an interview 60 years later, he said, "When I opened my office in Radio City, I must say I made a lot of mistakes. Perhaps the biggest mistake of all is to start out like a law firm does or like a medical firm does, and hope that your reputation alone will attract customers. I tried that. In fact, that was the standard among investment counselors. When I started out, I would have been looked down on if I had done any advertising. The result was that it took a long time to accumulate clients. Now that it is acceptable to be a salesman, I would surely think you ought to spend 3/4 of your time selling." This was a theme, as we shall see, which was to recur when Templeton later moved into the mutual fund business. Sometime after opening his office in New York, in order to save money, he moved the bulk of his operations to the suburb of Englewood, New Jersey, 45 minutes away from the center of Manhattan. Throughout the 1940s and 1950s, Templeton and his partners continued to build up their investment advisory business. Wartime and the subsequent Cold War provided early lessons in the wisdom of controlling clients' exposure to the stock market. Templeton was one of the first firms to attempt to regulate clients' exposure to the market on the basis of a quantitative assessment of the current level of the market, an approach that came to be known as the Yale or Vassar method, and which we describe in more detail in the next chapter. The key elements of this method were to reduce market exposure when it had become overvalued and increase it when it became undervalued against historical experience. Nothing sounds simpler or more logical. Buying low and selling high has been the street trader's watchword since markets began. It is, however, something that most investors find much harder to achieve in practice than it should be. Templeton's analysis was based on comparing the level of the market in a rigorous fashion with the earnings, cash flow, and yield characteristics of both the recent and more distant past. It proved to be a useful tool that, by his own account, was to help steer the firm's clients safely through the bear markets of the late 1940s and 1950s, while inevitably sacrificing some of the upside in the stock market's best years. It was only later that he was to develop the practice of basing his individual stock selection on forward rather than historic earnings. The fund management business. In 1954, looking for new ways to expand the business more quickly, Templeton decided to launch a new mutual fund. This was the Templeton Growth Fund, domiciled in Canada. It was unusual in being one of the very first mutual funds to offer North American investors the opportunity to invest in a managed fund that set out to invest across the globe. At the time, it was still a commonplace view among investment professionals that it was too risky to commit anything but a small proportion of their assets to investment opportunities outside the United States. In addition, legislation prevented many pension funds and charitable foundations from investing in securities outside the United States. The fund itself was the first of a number of new managed funds to be domiciled in Canada, where there was no capital gains tax. The tax advantages of the fund had obvious advantages to a U.S. investor, and they duly featured prominently in the way that the fund was marketed. Behind those immediate benefits, however, were the seeds of a distinctive new investment philosophy. Templeton's argument, still a minority view at the time but now mainstream thinking, was that widening the range of potential investment opportunities could only increase the universe of potential bargains to the benefit of investors. His view had always been that the risk of global investing is exaggerated and can, in any event, be offset by diversification. Research shows that a stock portfolio with investments around the world is likely to yield, in the long run, a higher return at a lower level of volatility than will a simple, diversified single-nation portfolio. Diversification should be the cornerstone of any investment program. It is a neat coincidence that the Templeton Growth Fund was launched just as the future Nobel Prize winner Harry Markowitz was demonstrating that diversification across poorly correlated asset classes could reduce investors' exposure to risk without jeopardizing returns, an insight that underlies much of modern financial theory. For many years, investor interest in the Templeton Growth Fund was limited. Its performance was strong in absolute terms, capitalizing as it did on the 1950s post-war recovery in equities, but it remained little known and poorly followed. For the first 10 years, as we show in Chapter 3, it would have struggled to keep pace with the MSCI World Index, had such a thing existed at the time. Any investment consultant who monitored its performance at the time would have been forced to conclude that it was a slow developer. Later, however, the performance of the fund was to improve dramatically, and, as its track record became better known through the efforts of his new partner, Jack Galbraith, who came in to market it, more investors and intermediaries began to take notice. Other firms also began to offer similar global funds, and before too long the mutual fund industry was growing at a furious pace. How, we asked him, did the change to a marketing-backed business come about? Templeton replied, "I was sitting in my office one day and a man came in and said he had been an airplane pilot during the war, but now he wanted to be a salesman. He thought I had a good performance in investments and asked, could he sell my mutual fund? I said, I don't have any money to pay you. And he said, that's all right, I'll just take a commission. His name was John Galbraith, and he started out by taking performance charts of my fund in Canada, the Templeton Growth Fund in Canada. The charts showing Templeton Growth Fund's extraordinary track record of performance later came to be known inside his firm as the Mountain, in recognition of its succession of soaring peaks. According to Templeton's biographer, Jack Galbraith was a trained accountant who had spent a number of years working in the fund industry before approaching Templeton with a proposal to help market his fund. In Templeton's account, his wife ran everything except the calling on brokers, which he did himself. He would walk into a broker's office and see somebody who wasn't busy and sit down beside them and say, tell me what mutual fund has the best results. They would name some firm, and he would say, look at this, and show them the chart of the Templeton Growth Fund. That caught their attention, and so a large number of them began to sell the fund to clients. He paid them a commission, and he kept a commission for himself. It worked like magic. According to Templeton's official biographer, Robert Herman, Galbraith had originally proposed a deal under which he could eventually acquire the fund's management company if he succeeded in increasing the assets of the fund tenfold over 10 years. Templeton declined this offer, but instead suggested that Galbraith acquire 20% of the fund's management company at the outset. This the latter did, although not before telling his wife that he had been disappointed to have ended up with only half a loaf, instead of the whole loaf he had wanted. The management company's stake was to become worth many millions of dollars and make Galbraith a very wealthy man. It was, ironically, only in the 1970s, however, as Galbraith and his wife began to build a larger marketing team, that the Templeton Growth Fund began consistently to outperform the market. Until that point, its track record had been impressive in absolute terms, but still had a tendency to underperform the markets it was investing in. It was during this period that Templeton began to invest heavily in the Japanese stock market, a contrarian move that was to play a large part in establishing his later reputation. At the height of this phase in its life, the Templeton Growth Fund had as much as 60% of its assets in Japanese stocks. Yet at the time, few professional investors would touch Japan, so little known or understood was the country. Having visited scores of countries on his regular travels abroad, and with an insatiable appetite for new information and experiences, John Templeton was ideally qualified to introduce thousands of American investors to the benefits of investing in international stocks. Templeton's partnership with Jack Galbraith proved a huge commercial success. Within 4 years, the Templeton Fund range, later expanded from the Growth Fund to incorporate a number of other funds managed on the same principles, had grown in size from $13 million to $100 million. By the 1980s, helped by the pro-business policies of the Reagan administration and the onset of the greatest bull market of the 20th century, the fund was measuring its assets in billions rather than millions of dollars. By the time the business was sold to Franklin Resources in 1992, the firm had assets of $21.3 billion, spread across a range of more than 70 funds, including a well-known emerging market fund managed by Dr. Mark Mobius, which had been launched in 1987. Templeton and his colleagues received several $100 million from the sale of the fund management and distribution companies they owned. Templeton personally, his son Jack, and his business partner Galbraith owned 70% of the voting stock in the business, according to press reports. It is worth emphasizing that not everything ran smoothly at all times. During the savage bear market in the early to mid-1970s, for example, the value of the Templeton Growth Fund fell sharply in 3 out of 5 years. The net asset value declined by 9.9% in 1973 and by a further 12.1% in 1974. The saving grace was that the fund's loss of value was less severe than the decline in the main market index, reflecting the defensive qualities of Templeton's rigorous value-oriented approach. It was a setback nonetheless. In 1974, the combined value of all the funds managed by Templeton amounted to no more than $13 million, a tiny fraction of the $90 billion empire that it was to become over the course of the next 30 years. Moving to the Bahamas. Another irony is that it was partly an accident that Templeton was still engaged in active money management at all when the bear market of the mid-1970s hit. In the late 1960s, by then already wealthy from the sale of his advisory and other investment businesses, he had decided to move his base from the United States to the Bahamas, where he was building a house on an exclusive private estate known as Lyford Key. Templeton had sold all his other business interests in the hope of retiring to spend more time on his charitable interests. Despite its later spectacular success, the reality is that he had been unable to find a buyer for the Templeton Growth Fund at the time. The family who had bought his other interests decided that they did not wish to acquire the fund. As a result, he decided to continue to manage it himself. He set up a small office above the local police station near his new home in the Bahamas, where he continued to live from 1968 until his death 40 years later. Working with minimal resources and distractions, he said that he spent an hour a day on the beach scanning scores of research reports, looking for stocks that he considered to be bargains. Being so far from the noise and bustle of Wall Street was, he quickly became convinced, a powerful contributory factor to his continued ability to do better than most of the big professional firms at the heart of New York's financial district. With the advantage of hindsight now, I think there are 2 reasons for this success. One is that if you're going to produce a better record than other people, you must not buy the same things as the other people. If you're going to have a superior record, you have to do something different from what the other security analysts are doing. And when you're 1,000 miles away from Wall Street in a different nation, it's easier to be independent and buy the things that other people are selling, and sell the things that other people are buying. That independence has proved to be a valuable help in our long-range performance. Then, the other factor is that so much of my time in New York was taken up with administration and in serving hundreds of clients that I didn't have the time for the study and research that are essential for a chartered financial analyst. And that was the area in which God had given me some talents. So now, in the Bahamas, I had more time to search for the best bargains. He had earlier told another biographer, William Proctor, "When my wife and I were looking for the best place to live, one of the questions we asked was, where can we carry on our work in the most pleasant surroundings? All my life I've enjoyed the open air, and especially the flowers, ocean beaches, and clear water of the tropics. We were attracted very strongly to ocean beaches, and now that we live here we are surrounded by 3 ocean beaches. So I use every opportunity when I can get away from routine work and telephones to take a briefcase full of papers and sit in the shade on the beach. There I concentrate either on security analysis or on religious reading or study. I find it's an excellent place to work. You can work with greater concentration there than you can in an office or in a home." Templeton went on to say that while his family investments and charitable activities took up most of his time, the fund was not neglected. "I spend, at most, an hour a day at the beach thinking and doing my work. There are too many demands on my time to spend any longer. But I do it almost every day I'm not traveling, and that turns out to be about 150 days a year. It is a very pleasant time of withdrawal, and the interesting thing is that it seems to be productive, too, in terms of producing good overall results for our mutual funds. To be able to work with the sand and ocean surrounding me seems to help me to think in worldwide terms." Market guru, global contrarian. Time and the market cycle also proved to be on his side. Having correctly spotted the potential explosive growth of the Japanese stock market in the early 1970s, by the end of that decade Templeton had switched his main focus of attention back to the American stock market. As early as 1982 he was announcing to the world, and indeed anyone who cared to listen, that he expected the U.S. stock market to boom over the coming years. It was a theme that he was to return to time and again over the next 15 years. It was also vindicated by events, as stock markets around the world, led by the United States, embarked on what was to prove the longest and most sustained bull market of all time. In 1982, for example, he went on the TV program Wall Street Tonight to declare that there was a better than even chance that the Dow Jones Industrial Average, then trading below 850, could hit 3,000 within 10 years. In the event, the market hit 3,000 in 1991, confirming Templeton's status as a market guru. Although with hindsight this looks like an obvious call, at the time it is easy to forget that many pundits were writing off the American stock market after nearly a decade of indifferent or calamitous returns. In August 1982, the same year that Templeton made his prediction, Businessweek had famously produced a cover story that announced the death of equities. In 1993, he predicted that the Dow Jones Index would hit 6,000 before the end of the century, which it duly did in 1996, before going on to peak at a remarkable 11,723 in January 2000. The 1970s was the start of a period that saw his reputation as a market guru rise by leaps and bounds, whereas before John Templeton had been a respected but largely unknown figure outside the narrow circle of Wall Street. Now, in his 70s, he was being hailed as one of the most famous investors of his generation. In all, he made 15 appearances on Louis Ruckeiser's widely followed TV show Wall Street Week, mostly to reiterate his message that the times were good and that this was an outstanding opportunity to invest in the United States stock market, as indeed it proved to be. Galbraith's marketing and PR efforts transformed the fund's visibility and helped to propel its fund manager into national prominence, exemplified by the first of several appearances on the front cover of Forbes magazine in 1978. By this time, too, Templeton had firmly established his reputation as a contrarian investor. Alongside his faith in the merits of global investing, he had long been convinced that the most reliable way of achieving the best returns was to concentrate on finding bargains wherever they could be found, regardless of prevailing fashion or sentiment. By definition, this meant buying things that most other investors did not want, and extending the search for bargains right across the world anywhere stocks were traded in size. "People are always asking me where the outlook is good, but that is the wrong question," he said on more than one occasion. "The right question is, where's the outlook most miserable?" The implication also was that it could take time for valuation anomalies to be put right. These insights remain at the heart of the Templeton investment philosophy. This philosophy can be summed up like this: buy stocks for less than they are worth, and hold them as long as it takes for the market to appreciate how undervalued they are. By definition also, this clearly implied that finding the best bargains could only be achieved by being prepared to go against conventional wisdom. In formulating his approach, Templeton acknowledged his debt to Ben Graham, the so-called father of security analysis, whose pioneering book, Security Analysis, written with David Dodd and first published in 1934, Templeton had read while an undergraduate. The book set down a series of analytical techniques for assessing the value of securities, all of which Templeton had subsequently used at different times as part of his own formidable analytical method. However, as will become clear, it is too simplistic to characterize his approach as pure value investing. A key part of Templeton's analytical technique is not just to look at companies' current earnings, balance sheet, and cash flow. What matters to an investor is how earnings and cash flow are likely to develop in the future, not where they are today. As Mark Mobius, one of Templeton's best-known disciples, puts it, you have to look at the future, not just at today. The technique that Templeton developed at his firm was to make sure that all the key variables of a potential share purchase should be projected several years into the future. He argued that a share that does not meet conventional value criteria, such as a high dividend yield or a low historic earnings multiple, could still be an attractive purchase if the key performance parameters were set to grow in the near future. By definition, therefore, a Templeton-influenced investor is interested in both growth and value. Or as Templeton himself put it in an interview once, looking for a good investment is nothing more than looking for a good bargain. Anything in theory could qualify. It was the combination of price and growth potential that was critical. Where he differed from classical deep value investors such as Ben Graham was in recognizing that historic valuation metrics were not sufficient to produce a bargain. His first and most famous fund was labeled the Templeton Growth Fund for a reason. How others see him. Mark Holowesko, his former assistant and chief investment officer, still occupies Templeton's office building in the Bahamas, but now runs his own fund management boutique. He gave us his personal reflections on the 15 years he spent working with John Templeton. This is how he recalled his early years. Sir John was a unique employer in many ways. For one thing, he paid me by the hour, even though I had a master's degree. He didn't care if I took 3 days off in a row and then worked 20 days in a row, as long as I was only paid to work so many hours a year. At the end of every week, I'd write a little note to him saying I worked so many hours, and he'd get a pen, write a check for me, and leave it on my desk. We did that for much longer than you would believe. I still have my first rejection letter from Sir John, where I asked him for a job and he turned me down, but wished me good luck in the future. I also still have my first raise, which was in November 1985. After 6 months, he very kindly gave me an increase of $1.50 an hour. Now I could afford cheese on my hamburger. It gives you some of the character of the guy. When I first started working for him, he always worked on hotel stationery because it was cheaper. Because it was half a cent a page cheaper to buy loose leaf and staple it together. We had loose leaf instead of legal pads. You could go on for days with stories like that. Working for him was incredibly tough. Here was someone who used to come into work 7 days a week. He'd come into work after church on Sundays. You were always behind him. He always drove you to do more than you would have done, just to try and keep up with his pace. Even when he was 75, he never let up. He's obviously brilliant, but his genius, I think, lies in his ability to take complex things and break them down into issues that are simple. His rules on investing sound very simplistic, but aren't. He could run circles around the guy who has got a Harvard MBA, but who is looking at the world in too complex a way. I got a job with him in the end because I wanted to take the CFA exam. I wrote to him and explained that you need another CFA to sponsor you, and he was the only one on the island. Would he do it? He said sure. After I passed the first level, I wrote him again, and that was when he invited me in for an interview. My first job was basically legwork. He came in during the Bhopal disaster, for example, which was a big issue for Union Carbide, and said, "What sort of liabilities were involved in similar instances in the past? What would the potential liability be for Union Carbide?" His attitude was, "Okay, here's a problem. The stock price is down tremendously. Let's just put some numbers around the problem and see what the market discount is." That's the sort of thing that I would do on his instruction. Eventually, I started picking stocks on my own, recommending ideas. Then I took on research responsibilities, then research responsibilities for the group. After that, I took on account management responsibilities, managing separate accounts. Eventually, in May 1987, he came in and he put all of his mutual funds on my desk and said, "From now on, why don't you write up the trade tickets? What you think should happen to these funds and leave them on my desk." People say Sir John's a stock picker, not a market timer. But as he handed over the management of his funds in May 1987, I think he was a pretty good market timer too. It was a baptism by fire. The U.S. stock market was to suffer its largest ever one-day fall in October 1987, when the Dow Jones Industrial Average fell by more than 500 points, a decline of 22%. In 1989, I became Director of Research and then eventually CIO. It's been a fun, exciting ride. One of the authors, Sandy Nairn, also recalls his early years working for Sir John as being unorthodox in their simplicity. I joined Templeton in 1990. Part of the process involved flying over to see Sir John and a couple of other people. My first big impression was the contrast with my experience when I joined my previous employer. The chief executive there didn't know my name. It was only a small company, but he had no involvement with the hiring process at all. It was all very hierarchical. Yet I went to Nassau, and here was one of the world's legendary investors sitting down and talking to you about your background and what interested you. It was clear that this wasn't a job for him, but a vocation. What really struck me was that he was the chairman of the company, owned the company, in fact, and yet he knew as much about any of the stocks in the funds as anyone else in the company. In fact, probably more. My second clear impression is that he didn't talk very much. Everyone else I have ever dealt with has talked. You just listened and occasionally responded. Sir John had an uncanny knack of letting you blather on indefinitely. He just soaked up information and put you at ease. He had delegated the management of the company to Tom Hansberger, largely, I think, because he wanted to remain directly involved with the investments. Again, this was the exact opposite of where I had come from. There, people couldn't get out of the investment business fast enough. They wanted to get themselves away from responsibility for making investment decisions. The attitude was very much, junior people do company analytical work. At worst, the guys at the top were portfolio managers. At best, they were strategists, or even completely divorced from it. But for Templeton, it was the complete opposite. As far as he was concerned, there was no higher form in life than being an analyst. The amazing thing is that he would have been 77 or 78 at this time. Everyone who went to see Sir John tried to figure out the secret of the Templeton approach. In fact, he'd tell you it all in the first 5 minutes, but you just didn't notice it. I know that my head was full of unconnected ideas at the time, like a tin full of broken biscuits. I knew about every investment technique in the world, but not about how to join them together. He just said to me, "Buy cheap stocks." There is a danger that you think this is too simplistic. Doesn't he know about this, that, and the other technique, you could ask? The trouble is that he absolutely did know these things. He absorbed them all, and yet he still came back to this simple approach. My view is that the level of clarity he had about the big issues is what defined his genius. I remember an example in the 1990s when the fund I was running had 18 to 20% in emerging markets, but I had reduced this to 3%, while everyone else in the industry still had a weighting of 20, 30, 40%. I asked him what I should do, and he just said, "In all my 45 years of investing, I have never thought it sensible to buy expensive stocks for my clients." And that was it. Next topic. His attitude was, "I don't care what everyone else says unless they can show me why I'm wrong in my judgment about the value of a company." The truth is that all he has ever cared about is what things are worth. If a share was worth too much, then he thought you should sell it. It was as simple as that. He was very careful with the selection of people he would employ, and that's why he spent time with them, because he was entrusting the future of the company to them. His CEO at the time was a wonderful character who hired people from very different backgrounds, anything from the straight-laced to the mad party animal. It made for a very different atmosphere. We all got on very well and had a lot of fun because we were all very different. What he didn't do was pick only people from the top business schools where they are all dragooned into thinking in a particular way. I think he just loved diversity. Mark Mobius, who now runs the Templeton Franklin's group range of highly successful emerging markets funds, recalled his own first dealings with Templeton. It all started in 1985 and 1986 when I was working for a brokerage company. They sent me to Taiwan to take over the management of a joint venture, the first of its kind in Taiwan at that time. After about a year and a half, I get a call from Sir John and from Tom Hansberger, his business partner, asking me to be the manager of a new fund they were setting up, the Templeton Emerging Markets Fund. After some negotiating, I came on board and started running that fund, which was then about $100 million in size. By 1994, it had grown to be worth $14 billion. Today, it has grown to $40 billion. The foresight that Templeton had in taking on this fund with Merrill Lynch, who had originally started it, told me something about the man. He had been looking at emerging markets for quite some time. He was a bargain-hunting global investor who was willing to go into markets where others feared to tread. It was difficult to leave Taiwan, but I decided that this was a chance to leap into something more exciting. It certainly wasn't the money. I wasn't going to get paid any more than I was making, and I had a lot of perks in my job in Taiwan. I had a driver and all that stuff. But those types of things don't really impress me, and I was more excited by the prospect of what was coming. As it happened, things just went from good to better. In hindsight, it was the right decision because in Taiwan, at most I would have managed $1 billion. Under Templeton, I ended up with a lot more than if I had stayed where I was. It really has turned out very nicely. Fortunately, I bought into his way of investing right from the start. I can't really remember why, because I was interested in technical analysis for a long time, and I taught some of that at the Chinese University in Hong Kong. When they expounded the Templeton philosophy, however, I think it just made an awful lot of sense. His genius was that he could simplify things to make it easy for anyone, even someone as thick-headed as me, to understand. One of his key insights was to realize that valuing a stock by reference to the price-earnings ratio today is far too simplistic. He would say, "Oh no, we don't want to look at what the PE is today. We want to look at what the PE will be in 5 years. Let's look at the future, not at the past." His approach was really growth and value. I would say that that is one of the things he had added to Graham and Dodd. He also believed in flexibility. There is a tendency for people to become rigid, which is not a good idea. The other aspect of working for Sir John is that he pretty much left us alone to do our own thing. Of course, he gave us guidelines on how to work, but generally speaking, he was hands-off. Whenever we needed help, he would give it, but he mainly let us run our own show. We never had any formal contact on how to invest anything, except at board meetings. That was a formal report of what we were doing. Other than that, the only real guidance was, Keep on looking for those bargains. Templeton, the man. Anyone who has met John Templeton has been struck at once by his politeness, his extraordinary capacity for hard work, and his ability to focus single-mindedly on the task in hand. According to Haloesco, his assistant in the Bahamas for many years, Templeton was always fastidious about using his time to maximum effect. Gary Moore, a long-standing friend of Sir John, who advised him on ethical investment, recalls that a typical appointment would last from 8:02 to 8:13. Once the business was done, it was always on to the next task without a moment's break. Jack Galbraith, Templeton's business partner, recalled the same thing. By nature, he doesn't want to waste time, so you don't ever find yourself sitting around exchanging small talk. You always have a sense that he has more things to do than time to do it. Just as he respects his own time, Templeton extends that respect to the time of others. John Hunter, one of his Canadian stockbrokers, says that when he tells him that he will call at 9:15 Canadian time, the call will invariably come through at precisely that time, from wherever Templeton is traveling in the world. In fact, to ensure that he is prompt, he has always set his watch 10 minutes fast. Hard work, punctuality, and commitment are qualities that Templeton tried to impress on all those he met and worked with. During his working life, he made a habit of carrying a book or a stack of research reports with him so as not to have to waste any time while traveling. His notorious thrift extended to all aspects of business life. When Haloesco started working for Templeton, to give just one of many possible examples, he was instructed to staple together bits of scrap paper so as to save on the cost of buying new stationery. When asked whether the founder was really as careful with money as his reputation suggested, Jim Wood, who led the marketing for the Templeton firm's institutional accounts business in the late 1980s and early 1990s, replied, laughing, "My guess is he died with his first nickel in his pocket." When a group of potential Chinese investors arrived in the Bahamas to meet him, he recalled, Templeton presented them all with a cheap alarm clock that cost about $5 apiece, which was somewhat embarrassing. He could, however, be generous to his employees, Mr. Wood recalls, and although he was to become fabulously wealthy in his later years, he never lost touch with his origins. I don't think that Sir John really cared how much money he was making. He never had any money growing up, and I don't think he cared a whole lot. He was doing what he wanted to do, and he just thought that if he kept working, the rest of it would take care of itself. During the first 15 to 20 years of the Templeton Growth Fund, when the fund barely grew in size, I guarantee he never got close to jumping out of the window. Throughout his life, Templeton relied on his Christian faith to sustain him through adversity. Never was this more needed than in 1951 when his first wife Judith died after a motor accident. Templeton was left with 3 young children to bring up, as well as the demands of running his own business. According to his friends, he coped with this appalling reverse with great resolve, convinced by his faith that it was futile to challenge God's design. 5 years later, he married his second wife Irene and lived contentedly with her until her death in 1993. His eldest son, John Templeton, Jr., has for many years taken a keen interest in the business that his father founded, but always insisted that he had no intention of competing in the same business while his father was alive. Instead, he pursued a highly successful career as a pediatric surgeon. After selling the business, John Templeton lived quietly but productively in the Bahamas, where he was well known as a generous local benefactor. He worked from a new office building just outside the gates to the Lyford Key estate, and a short walk from the first-floor room above the police station, which had served as his office when he first came to the Bahamas. The new office was built shortly before the sale of his fund management business in 1992. It is from this building, and with the help of his long-serving administrative staff, that he continued to administer his wide range of philanthropic and charitable activities until his death on July 8, 2008. The Templeton Foundation itself operates from West Conshohocken, Pennsylvania, while the fund management operation, now part of the Franklin Templeton Group, remains in Florida, where it had been set up in the 1980s to handle the administrative and marketing operations of the Templeton funds. With his love of work and serious purpose, John Templeton was, some felt, easier to admire and respect than to know well. The Canadian fund manager Peter Cundill, an exponent of Grahamite value investing, met John Templeton on several occasions and described him as something of a mentor. After a business meeting in Lyford Key, having been across to see the older man, he noted in his diary, "He is extraordinary in the breadth of his skills and interests, and yet he can be so dry and seemingly humorless, even egotistical and mean-minded. He is a highly complex personality, for all the beaming, patriarchal smile, and yet I always have to acknowledge that he has given me enormous help, not just in financial matters, but in spiritual ways too. Somehow I still can't imagine having a warm dinner with him where the reserve is abandoned. Maybe it will happen one day." His colleague Jim Wood, although he developed an excellent working relationship with his boss and had regular discussions with him, says, "I think he tried, but it just wasn't in him to be warm and fuzzy. He almost never watched television or movies, and hardly ever read a novel." In 1972, Templeton established the Templeton Prize, an annual award that was originally conceived to do for religious studies what the Nobel Foundation does for academic and intellectual work. By design, the prize is the most lavishly endowed of any in the world, but was not, he felt, as widely acknowledged as it deserved to be. In more recent years, the foundation, founded in 1987, has quietly modified its objectives away from the ostensibly religious to encourage and support scientific analysis of big questions related to human purpose. At the end of 1989, it had assets of $1.7 billion, making it one of the 40 largest foundations in the United States. Templeton published a series of books offering practical advice to young people on how to advance their spiritual awareness. He also gave money to schools and other local communities to encourage them to instill in young people what he liked to call the laws of life. Chapter 2. Investment Counsel. As we have already seen, John Templeton's investment career falls into a number of distinct but overlapping phases. In this chapter, we concentrate on his early career as an investment counselor, which broadly spans the 2 decades between 1940 and 1960. Although this period of his life was to make him a wealthy and respected businessman in the United States, one who appeared more than once in the pages of the business press, it was not until the 1970s, when he was already in his 60s, that he was to become globally known and respected as a figure of substance in the international investment business. His early professional years, before he moved into the higher profile and more profitable business of fund management, are nevertheless full of interest. It was during this period that many of the ideas with which he is now widely associated were first formulated, as can be seen in the internal memos and letters that he sent to the firm's clients. A small selection of these is reproduced in full or in part in this chapter. More examples are reproduced in the appendix. Although written more than 50 years ago, the clarity of thought and expression that they display provide some fascinating clues to the character and intellect of their author. However rapidly the world may change, the fundamentals of sound investment remain the same from one generation to the next. As far as we know, John Templeton's decision to become an investment counselor had already been made by the time he completed his undergraduate studies at Yale University. It was not until 2 years after his return to the United States from Oxford that he was able to take the first steps toward achieving his professional ambition. An investment firm bearing his name was, it seems, first set up in 1938, while he was still employed elsewhere. By his own account, his first big break came when he bought a small investment advisory business in New York for $5,000, thereby getting his name on the door for the first time and moving into an office in Rockefeller Center. 2 years later, he merged this business with another investment counseling firm to create a new firm, Templeton, Dobro, and Vance. Soon afterward, although he maintained the Rockefeller Plaza address. In order to save money, he moved the bulk of the firm's employees and operations to the suburb of Englewood, New Jersey, about 9 miles north of Manhattan, and a 45-minute distance by train and subway. Englewood was also where he and his wife lived. For the next 20 years, he and his partners in this investment advisory partnership succeeded in building a growing and profitable business, looking after the money of a wide range of clients, principally wealthy families, estates, and trust funds. The firm, in due course, added a number of colleges, corporations, foundations, and institutions to the client list. It also was active in promoting the merits of profit-sharing plans to companies. Templeton's 80% shareholding in the partnership was funded initially by a combination of his savings and by the gains on his stock market portfolio, which, so he later recalled, enabled him to survive during the firm's first 5 years without the need to draw an income every month. In a memo about the firm that he circulated to clients and friends in 1957, he listed what he regarded as the firm's most important achievements. 1. Gross income has increased 25-fold in 16 years. 2. Net worth has increased more than 20-fold in 16 years. 3. Personnel has increased 6-fold in 16 years. 4. From its beginning in one city only, the organization now works throughout the United States and Canada, with offices in 5 cities. "We prefer to think of this organization," he went on, "more as a sort of family than as a corporation. The group of partners and clients is closely knit and can still be thought of as a family, although it has grown from nothing to become one of the 10 largest investment counsel companies in the nation. The company began 18 years ago for the purpose of providing assistance of unequaled quality for investors. The growth has been consistent and steady year after year. This growth was attributable, he claimed, to the fact that the firm had helped its clients to achieve both good results and peace of mind. The good results, in turn, were largely the result of 2 policies in which our work has been different from that of others, namely, 1. Emphasis on the importance of practical long-term investment planning, and 2. Security analysis, which is quantitative and systematic. As events turned out, Templeton had spotted an opportunity well ahead of many of his peers. In the same memo, he pointed out that the profession of investment counselor had been new and barely known to the wider public when he started out. Before the advent of investment counsel, most financial advice had been offered by brokers, investment banks, lawyers, and other professionals, none of whom were free of conflicts of interest, the besetting problem of the financial services industry, then as now. An investment counselor, by contrast, as he saw it, could provide a uniquely dispassionate form of help not previously available anywhere in the world, which Templeton summed up in these 6 words: confidential, unbiased, expert, continuous, conservative, and personalized. This fledgling new profession received an early boost in 1942, when the Internal Revenue Service in the United States agreed to allow the fees for investment counsel to be deductible against tax for the first time. By the 1950s, buoyed by the continued post-war expansion of the American economy, the new profession was growing sufficiently fast to justify forming its own trade association, in which Templeton took a leading role. It appointed an early exponent of public relations to help promote its advantages to potential clients. Templeton and his partners subsequently sold the business to an insurance company run by the Richardson family, enabling him to concentrate more fully on what by then had become to him the more interesting and more profitable business of fund management. By that stage, Templeton's firm was acting as an investment advisor to 5 different funds, in addition to its conventional clients, and his fund management subsidiary was briefly listed on the stock market. The Yale Method. We know in broad terms the method that Templeton and his colleagues employed to manage the money of their clients, but we do not have the records that enable us to analyze his performance as an investment counselor in great detail. An internal memo prepared by one of Templeton's colleagues, reproduced in the appendix, showed that the firm did attempt to measure and report to clients how much value its advice had added. Between 1947 and 1952, the memo suggests that, according to the firm's Progress Index, a representative client's portfolio was worth 25% more than it would have probably have been if it had not been under continuous supervision by Templeton and his colleagues. Templeton himself at one point refers to the success of his own personal portfolio and suggests that the impact of portfolio planning could be to double a client's funds over 20 years. In practice, it is not as easy to judge investment performance in an advisory business as it is for a fund, since so much in the former case depends on the individual circumstances and risk profile of the client. The performance of a fund, which of necessity and by design maintains a single portfolio for all its investors, is more transparent and therefore easier for an outsider to analyze. Judging by the steady growth of the business, however, there seems no reason to doubt that the results of the firm's disciplined investment strategy were satisfactory. In a magazine profile some years after the business was established, Templeton described the role of an investment counsel as follows: "Our role as investment counsel is not unlike that of a doctor or a lawyer, except that there are no midnight emergencies. Much as a law firm has its specialists in various phases of law, we have specialists in the different types of investments: electronics, steel, transport, petroleum, etc. And our clients regard us as they would their doctor or their lawyer with confidence. We, in turn, respect their confidence and treat them and their investment needs in an individual manner just as a doctor would treat the needs of those who come to him. The relationship between counselor and client is, and must be, highly personal, since each client's problems differ from those of all others." What we do know from the firm's surviving records is that John Templeton's advisory firm managed most clients' money on the basis of what he said had come to be known as the Yale method, so called after the university that had adopted the approach at the time. As Yale was Templeton's own alma mater, from which he had graduated in 1934 with a degree in economics, it is interesting to speculate how and when it came to adopt the principles he employed in managing money for his own firm's clients. Did he himself have a say in the new strategy being adopted by the university, as his letters to clients seem to imply? There is an intriguing suggestion that Yale was one of the few institutions to which John Templeton refused to give any money later in his life, so there may be more to this story than we have been able to establish. The Yale method described by Templeton should not be confused with the multi-asset strategy adopted more recently by the Yale Endowment Fund, an approach introduced by Yale's chief investment officer, David Swensen. It is probably worth recalling that at the time of his becoming a professional investor, the science of investment was still in its relative infancy. Benjamin Graham's seminal textbook, Security Analysis, for example, written with David Dodd, had only been published for the first time in 1934. Templeton read and appreciated Graham's work, describing it later as one of the greatest influences on his thinking. Another landmark text for security analysts, The Theory of Investment Value, by John Burr Williams, originally written as a thesis at Harvard University, was not published until 1938. By then, Templeton had already completed his education in England with 2 years as a Rhodes Scholar at Oxford University. While in Oxford, although he had majored in economics at Yale, he was taught by a law don at his college, Balliol. Despite its eminence, the University of Oxford employed no specialist tutors in business, let alone finance or investment, at that time. The essential feature of Templeton's approach as an investment counselor was to adjust the amount of money that investors held in the 3 main asset classes, equities, bonds, and cash, in the light of the stock market's current strength or weakness. When the market was strong, or high compared to its normal trading levels, the proportion in stocks was reduced. When the market was down, and trading at a low level relative to its normal performance, the holdings of equities were increased. Any money that was not invested in equities was held instead in bonds or cash. This broad approach is one that is still followed by investment advisory firms today, although the basis for deciding how much to allocate to each of the main asset classes varies markedly from firm to firm and is rarely as systematic as Templeton's approach. In the 1940s, when Templeton first began to implement such an approach, however, it was still a relative novelty. The distinctive attribute of the Yale method, which came naturally to Templeton's orderly mind, was its use of statistical analysis to assess the level of the stock market. He employed a formulaic approach, rather than human judgment, in determining what proportion of clients' money should be held in equities. This figure was directly and explicitly related to the value of the Dow Jones Industrial Average, the most widely followed index of its day. The normal equity allocation for an average client of the firm was 60%, although this proportion could vary from as little as 25% to as much as 90%, depending on an individual's particular circumstances. This normal equity allocation was then adjusted up or down to reflect the extent to which, in the firm's judgment, the market had risen above its normal zone. So, for the average client, the equity proportion could in theory rise from its baseline of 60% to as much as 100% or fall to as little as 0% at times of market extremes. One of the first surviving memos that Templeton wrote to his clients dates from 1945 and makes the case for a disciplined, simple, and coherent approach to investment. Planned investment. Memorandum to Clients, 1945. It is a continual source of surprise to Mr. Vance, Mr. Dobro, and me, when speaking for the first time with investors with whom we have not spoken before, that so very many people seem never to have thought out comprehensively the nature and problems of investment management. So many go along, year after year, in a haphazard manner, buying a stock now and then whenever some situation, which particularly strikes their fancy, is called to their attention. In a steady or rising market, the haphazard investor usually obtains profitable results and is lulled into a false sense of security. Then along comes a decline like those which culminated in 1921, 1932, 1938, and 1942, and the good record is more than wiped out because he had no plan for capturing and locking up the profits in the happy days. In a rising market, inexperienced investors may obtain the best results far surpassing the averages, because they often select highly volatile stocks. As every analyst knows, the fastest rises are to be expected in low-priced stocks, stocks of marginal companies, and stocks of companies having large debt and preferred claims. It only takes a few minutes to select a list of stocks which is sure to surpass the market averages if the average rises. The catch is that, if the market declines, those same stocks are the ones which fall with disastrous acceleration. Many people act as if the selection of particular stocks and bonds is about all there is to the problem of conducting an investment program. Of course, the element of selection is important. A carefully thought-out method for weeding out overvalued stocks and replacing them with undervalued stocks does produce profits. But the backbone of an investment program is the question of when to buy and when to sell. The first step in planning is to divide the stocks and equities on the one hand from the cash and bonds on the other. The second step is to think out and adhere to a program for shifting out of stocks when they are high and back into stocks when they are again quoted at bargain prices. The stock market always has been and always will be subject to wide degrees of fluctuations. When prices decline farther and farther, it is only natural human emotion to become cautious. Investors who have no prearranged plan to guide them not only fail to add to their stock holdings at the lower levels, sometimes because they have nothing left to buy with, but too frequently they add to the downward pressure by selling out part or all the stocks they own. Conversely, at other times, stock prices are pushed up far above real values by the understandable human tendency to buy when businessmen and friends are preponderantly prosperous and optimistic. If an investor can sell out when the very top is reached and then buy back at the nadir of the subsequent stock market decline, he will indeed grow rich quickly. But this can be done only by extraordinary luck. We have never found anyone who could forecast the rises and declines of the stock market correctly and consistently. Mr. Alfred Coles recently completed a week-by-week study of the results which would have been obtained by following strictly the forecasting advice of 11 agencies which have published stock market trend forecasts throughout the 15 years from 1928 to 1943. He found that the forecasts were correct only 0.2% more than would be expected if the forecasts had been made just at random. If no one can forecast the stock market trend accurately and consistently, how then, it may be asked, can an investment plan include the important element of shifting the balance between stocks and bonds in the fund? In answer to that question, this company developed in 1938 and put into practice certain principles which make use of the major market fluctuations without attempting to forecast. Subsequently, such principles have become known as the Yale Plan or the Vassar Plan. The successful results of these principles in the management of those two college endowments are available in published sources. In simplest terms, the balance of the investment fund is shifted gradually step by step away from stocks and into bonds when the stock market rises, and then subsequently back from bonds into stocks when the market declines. The result is a moderate growth in the invested funds over each completed market cycle, without the need for any predictions of trends or turning points. An investment plan incorporating these principles assures you that you will be ready and able to buy stocks in periods of gloom when others are selling, and that you will be selling when prices are reaching new high levels and optimism abounds. Any sound long-range investment program requires patience and perseverance. Perhaps that is why so few investors follow any plan. Years may go by before the risks of haphazard stock purchasing are revealed by losses. And years may go by before experience proves the increased safety and enduring growth achieved by planning. Over a period of 20 years, however, it is not too much to expect that investment planning may cause the invested funds to double. This message was one that continued to form the basis of the firm's pitch to clients for many years. By 1957, according to an internal document, Templeton and his colleagues were using this method as the basis of their advice to 99% of their clients. He believed that as the manager of other people's money, it was my duty, an act of faith, to see that their money is handled wisely, a principle to which he held firm throughout his career. High professional standards were not to be compromised. That did not mean, however, that the business was not run in a commercial way. As a businessman, John Templeton was well aware of the commercial value to his firm of having his clients invested in what was, at heart, a standardized form of investment program, one that could be replicated across many portfolios with little increase in cost. His biggest regret, as we have seen later, was that he did not spend more time on marketing the business. How, then, did the system work? This is how Templeton himself set out to explain the methodology in the mid-1950s. What is normal for stock prices? Confidential memorandum to clients, May 17, 1954. The economic theory developed by Templeton, Dobro, and Vance, Inc. for calculating the normal level of stock prices is simple. There are only three elements. 1. Stock prices would be normal if they bore the same relationship to current earnings as has been customary in the latest 20 years. 2. Stock prices would be normal if they bore the same relationship to the current cost of replacing the assets of the corporations as has been customary in the latest 20 years. 3. When, because of changes in tax laws or changes in the money supply, high-grade preferred stocks sell lower in relation to dividends than has been customary in the last 20 years, then it should be normal for common stocks to sell lower in relations to earnings, and vice versa. Although the theory is simple, the actual calculation involves many thousands of figures. We take care to define accurately each word used in the three principles above, and then the arithmetic is worked out on the basis of a large sample of representative stocks. The estimate of normal based on the three principles above is valid only when applied to a diversified list of industrial common stocks. Different principles are needed if we attempt to appraise the normal for any particular stock. In order that our calculations may be always up to date, normal for stock prices is recalculated each month. In the latest 20 years, normal has shown a strong upward tendency, partly because of the change in the purchasing power of the dollar, but more importantly because corporations have retained, after payment of dividends, a large part of their earnings each year. Normal for stock prices based on the principles expressed above has been computed consistently at a higher figure than the figure arrived at by any other agency attempting to calculate normal. This has meant that the clients of Templeton, Dobro, and Vance, Inc. have been more heavily invested in common stocks, and this has been a profitable situation so far. It is interesting to note how the three principles mentioned in this memo are all variants of market valuation methods that remain widely adopted today, although better known in some cases by other names. The relationship between the market's current price-earnings ratio and its long-run average is a calculation that has been popularized recently by Professor Robert Shiller as the cyclically adjusted price-earnings ratio. The relationship between market valuations and replacement cost of assets anticipates a formula now better known in professional circles as Tobin's Q, named after the Nobel Prize-winning economist James Tobin, who popularized the idea in an important academic paper in the 1950s. The relationship between the yield on fixed interest securities and the yield on equities is a widely used analytical tool, one formulation of which is the basis of the so-called Federal Reserve model, so-called because of its use in research published by the U.S. Central Bank in the 1990s. One of Templeton's colleagues at Templeton, Dobro, and Vance, Brevoort Stout, added some further explanatory detail of the practical issues involved in running such a program for clients by inserting a table at the end of his memo illustrating how simply a client's stock market exposure would be adjusted for different levels of the stock market as represented by the Dow Jones Industrial Average. It was not until the 1970s that the S&P 500 index, rather than the Dow Jones index, was to become the most widely used index in measuring the performance of the market. Program Balancing Explained. Memorandum to Clients, October 1, 1953. Those of our clients who follow a long-range investment program, and the great majority do, may find it helpful if we review and explain several of the practical considerations which arise when the level of stock prices moves from one zone to another. To clarify this discussion, a typical 60% program, based on normal as computed late in September 1953, is attached. Recently, stock prices as a whole, usually referred to as the market, have been hovering around the boundary between the first zone below normal and the second zone below normal. Author's note: the Dow Jones Industrial Average closed at 265.7 on October 1, 1953. A dip into the second zone below normal calls for an increase in the proportion each such portfolio holds in stocks. For most clients, the increase is 10 percentage points. For example, if a portfolio is managed on the basis of a 60% program, a drop by the market into the second zone below normal would call for raising the percentage in stocks to 70% of the total fund. A drop into the third zone below normal would call for 80% in stocks. When, following such purchases, prices rise, no steps would be taken to reduce the percentage in stocks until the market reached the top of the normal zone, at which time profits would be taken to a sufficient extent to restore the normal percentage called for by the program. Using the foregoing example of a 60% program, no action would be taken to reduce the proportion in stocks until the market rose above normal, at which time sales would be made to restore the proportions to 60% in stocks and 40% in reserve. In the process of acting to keep our clients' portfolios in proper balance according to their respective individual programs, we are confronted with several practical problems. An explanation of these problems and how we solve them may prove timely and enlightening. Suppose that today the market dropped from the first zone below normal into the second zone below normal. Theoretically, this would call for stock purchases by hundreds of our clients. It would, however, be impractical and unwise to place buying orders or make buying recommendations for all of our clients on any one day. In the first place, we could not devote the care and attention to each individual client's requirements necessary to assure the proper selling and buying selections for his portfolio. In the second place, the sudden impact of heavy mass buying on the stocks selected for purchase would tend to drive up the quotations, and would thus defeat our purpose of buying at bargain prices. Our solution to this problem is to defer until the date of the month which corresponds to the particular client's inventory date, our special balancing review. For example, portfolios of clients whose quarterly inventories are dated on, say, the 8th of the month, come up for special balancing review on or about the 8th day of each month. Each portfolio is, of course, reviewed for other purposes more frequently than once each month, but this special balancing review is a fixed monthly routine. If, on the balancing date for a particular client, balancing action is called for by the level of the stock market and by the client's program, we immediately undertake or recommend appropriate balancing transactions for that client. This procedure spreads balancing transactions for our clientele over the course of 30 days, or more if the market remains only briefly in the zone which requires positive action, permitting careful attention to each client's needs and avoiding sudden excessive market pressures. It is unlikely that any resulting delay in buying, pending the balancing review date, would prove disadvantageous. Only in the event that the market drops into a buying zone, recovers from it before the balancing review date, and continues to rise to above normal levels without again returning to or below the buying zone, would the delay cause a client to lose out on profiting fully from such a market price swing. An additional problem is the proper action in a case such as this. On the client's balancing review date, the market is in a buying zone. We recommend specific purchases. By the time we receive the client's approval, the market is no longer in the buying zone. What then? Unless the intervening rise in the market has been extreme, we go ahead with the actual buying once it has been recommended, except that we may have to substitute a different stock for one which has scored too great an individual rise. Our reasoning is that the exact zone limits are useful tools for program planning purposes, but should not be so strictly adhered to as to cause undue hesitation or vacillation in actual practice. It might be pointed out that we recompute the level of the normal zone each month. Any resulting change in the normal zone causes similar changes in the boundaries between the zones above and below normal. As in the case of the above-mentioned possibility of intervening changes in the level of the stock market, any such intervening changes in our computational normal are not allowed to prevent prompt and logical action. To summarize, in the case of those portfolios for which we are authorized to act on our own discretion, we reach our balancing decision on the basis of the relation of the market to the program on balancing date and, if action is required, we place orders at once. For those clients to whom we offer recommendations, we recommend on the basis of the relation of the market to the program on balancing date and execute when approval has been received, regardless of intervening market movements, unless such movements have been extreme. Those few clients who, on receipt of our recommendations, carry out their own executions, should follow a similar procedure. From this and other memoranda prepared by the firm, it is possible to deduce more precisely how the allocation to equities varied with the level of the Dow Jones Industrial Average and its relationship to its normal range, as calculated by Templeton and his colleagues. If and when the stock market was trading more than 60% above its normal level, the proportion in stocks should be reduced to 0. When stocks were trading more than 30% below normal, the allocation to stocks for the average client could theoretically rise to as much as 100%. The first point to note here are that the allocation to equities which Templeton and his colleagues were recommending, both the 60% starting point for the average client and the potential maximum allocation, was higher than many of his peers would have been comfortable with at the time. As Templeton himself acknowledged in the memo cited earlier, this was one of the reasons why his clients enjoyed higher returns than those who retained other advisors. At the same time, the method was, evidently, a contrarian strategy: buy when others are selling, and sell when others are buying. This same approach was to become the hallmark of his later career as a fund manager and remained an essential feature of his investment approach throughout his life. Nobody with any experience of managing client money, however, should underestimate the difficulty of persuading clients to increase their holdings of stocks when markets have been falling or selling down their holdings when it has been rising. In fact, most of the strands that were later to be formulated as John Templeton's investment approach in his later years are already clearly evident in his writings during his years as an investment counsel. A number of themes, which recur throughout the firm's communications with its clients, anticipate the ideas with which he was later to be closely associated as a prominent and public figure in the investment business. The bedrock of his philosophy of investment, it is clear, was already formed before he was 30 and was not to alter in any material way subsequently. Experience only served to reinforce the strength of these convictions. At different times, John Templeton would offer clients the firm's analysis of where the stock market stood in relation to the normal values it calculated on a monthly basis. One of the first occasions we can find was a memo written in March 1947 entitled "The Future Range of Stock Prices." In this he explained at some length, based on analyzing three familiar factors: corporate earnings, bond yields, and the replacement cost of assets, why, in the firm's view, the stock market was currently trading some 50%. A simpler way to grasp how the system worked was seen in figures, graphs, as one of a number of attempts made by the firm to illustrate how the methodology worked. For instance, the shaded area in the middle of two upwardly sloping trend lines showed the firm's estimates of what would be a normal trading range for the stock market based on their calculations of historical experience. This was then compared with the actual behavior of the market, represented in this case by the Standard & Poor's Index of Industrial Stock Prices rather than the Dow Jones Index. Although the firm did not start advising clients until World War II, the calculations are shown back to the early 1920s. This had the happy effect of showing that the methodology would have reduced client holdings of stocks in the run-up to the 1929 crash, when the normal zone was well below the actual market level, and again in the late 1930s. The graph shows the firm advising clients to build their equity exposure during most of the war years and again in the late 1940s and early 1950s, but reducing it in 1946 to 1947 and again in the mid-1950s. A second chart sent some years earlier to the firm's clients, but less easy to interpret, is even more explicit about how the firm's methodology would have positioned their clients' equity allocation in the years 1922 to 1953. A key part of that chart showed the equity allocation of a notional average client fund being cut from 60% in 1922 to 0% in early 1928. Then increasing all the way back up to 100% by the end of 1931. It is important to emphasize that the purpose of the Yale method was to take subjective analysis out of the process. Templeton and his colleagues always emphasized that short-term movements were unpredictable. The primary purpose of estimating the normal zone was to provide an indicator of risk, not to attempt to predict what future returns might be. The analysis did, however, enable Templeton to describe, in his 1947 memo, a possible range of future levels for the Dow Jones Industrial Average. Over the subsequent 10 years, he suggested, it was likely that the Dow, then standing at 173, would trade in a range between 176 and 256 roughly 50% of the time, below 173 around 25% of the time, and above 256 25% of the time. With the full benefit of hindsight, we can see that, in fact, he underestimated the strength of the post-war bull market that was about to unfold. Ironically, perhaps, vindication of his view that it is impossible to forecast market levels reliably in advance. In the 10 years that followed his memo, the Dow Jones traded below 173 just 2% of the time, in the 176 to 256 range 39% of the time, and in the highest range, above 256, 59% of the time. The risk, as it turned out, was all on the upside. In general, the method seems to have served its purpose in reducing clients' exposure to volatility. As we now know, the period of 1945 to 1960 was one of continued economic growth and prosperity, punctuated by intermittent military concerns and one war in Korea, 1950 to 1951. There was unusually only one severe recession in 1957, for which clients of Templeton, Dobro, and Vance were well prepared, having been urged to start reducing their holdings of equities as early as the spring of 1955. True to its normal form, the stock market itself turned down in mid-1956, some months before the onset of the recession. Note also, however, how in almost every case the stock market was higher 12 and 36 months after Templeton's comments were published. A useful reminder that in normal times investors neglect equities at their peril. There is no better way of capturing the way that the firm's methods worked than by comparing side by side, as Templeton himself did in 1955, his comments on where the stock market stood in 1950 and his observations on the same subject 5 years later. Clear thinking, augmented by numerically quantified statistics, was what he had promised his clients, and that in general, as the evidence of the Templeton letter, as his notes to clients were called, makes clear, was what they received. It was simply a function of historical experience that his historical studies, relating as they did to experience in the first half of the century, led him to underestimate the length of the 1949 to 1956 bull market. The second half of the 20th century turned out to be very different in character to the first. For the modern investor, it is interesting to note, too, how Templeton succeeded in picking up on some longer-term themes that were to become of greater importance to investors as the century progressed. In 1945, for example, he wrote a long article for Barron's explaining why he was expecting a higher price for oil and greatly increased earnings for oil-producing companies. His clients, he noted in an update 11 years later, had been more invested in oil stocks than any other single industry. The 6 stocks he named in the original Barron's article had risen 620% over the 11-year period. By the end of the 1950s, in his view, the risks in owning oil stocks had increased dramatically, however. Around the same time, he tackled the fashionable argument on Wall Street, widely used to justify the new highs that the stock market was making, that the onset of inflation in the post-war period, which he had long forecast, justified the high level of stock prices prevailing at that time. It did not, in his view, but events were to demonstrate that the stock market continued to power ahead well into the 1960s. At periodic intervals, Templeton wrote letters to his clients explaining why a sudden fall in the stock market was actually good, not bad, news for investors with a medium to long-term horizon. The idea that stocks can be more, not less, attractive when the market falls is one of the counterintuitive insights that inexperienced investors sometimes find difficult to take on board. Graham and Buffett are among those who have tried to explain this apparent paradox. It is hard, though, to match the clarity and lucidity of Templeton's explanation, written at a time shortly after World War II, when the markets were becoming preoccupied by the developing Cold War, and many stocks were selling on single-figure P/E ratios. By this point in 1948, it is worth noting, clients of the firm had been allocated above normal weightings in equities for nearly 3 years, and as the market had traded sideways for almost the entire period, it is possible to speculate that some were anxiously demanding reassurance that their portfolios were still in capable hands. The best thing that could happen. Memorandum to clients, September 21st, 1948. The stock market went down yesterday. My friends in Wall Street are sad. I can understand their emotions, but it only illustrates again the fact that more and more investors should adopt and adhere to the long-range, non-forecasting programs used by the clients of Templeton, Dobro & Vance, Inc. These programs are designed to profit from stock market cycles without the need for predicting such cycles. For an investor following a program of this nature, as we have said before, the best thing which could happen is to have the stock market go down from today's level of 177 to 128 before the next long bull market begins. An investor following an average program has 70% in common stocks today, which will participate in the capital gains during the next bull market. However, if the market declines to 128 before the bull market begins, such an investor will have 100% in stocks with which to participate in future capital gains. In other words, if a bull market begins now, the investor will make a large profit. But if the market first declines to 128 before the bull market begins, he will make an extra $19,000 approximately on each $100,000 involved in the program. If the market continues to decline, the long-range programs will call for purchasing more stocks at successively low levels. Of course, if there were any way to know for sure that the stock market would decline to 128, we would wait until then to make any purchases. In fact, we would go further than that and sell out the stocks now held in order to repurchase at the bottom. But the fact is that no one can possibly know for sure what the stock market will do. It is also possible that a long bull market may start immediately. If there were any way to know this for certain, we should immediately buy common stocks on margin at once. Here again, no one can possibly be sure what the stock market will do. The prudent and conservative policy is to follow a long-range program designed to profit from stock market cycles without the need for predicting either the timing or extent of such cycles. Because the stock market declined yesterday and is now 9% below its level 3 months ago, investors generally are unhappy. Even for those investors who have not yet adopted a long-range program, this emotion is illogical, if such investors are still in the stage of accumulating their wealth. Low market prices work to the advantage of an investor who makes it a practice to reinvest dividends or an investor who makes annual savings from his business or salary. For more than 2 years, stock prices have been remarkably low in relation to earnings. In fact, today stock prices are lower in relation to earnings than in any peacetime year as far back as records are available. This means simply that a person with new money to invest can obtain unusual bargains. Author's note: the Dow Jones Industrial Average in September 1948 traded in a narrow range between 178 and 185, and was not to start rising until June 1949, after which it rose by around 40% in the next 2 years. He can buy shares in some of America's largest and soundest enterprises for less than 5 times current rate of earnings. If the current rate of earnings is maintained, the net worth of his shares plus the dividends received will cause the value of his investment to double in less than 5 years. Even if future earnings were only 1/2 of current earnings, his purchases would still represent attractive bargains. This memorandum is not written merely to point out the silver lining of a cloud. It is intended as a part of the long educational program to persuade more and more investors to adopt sound and long-range investment programs. In December 1950, Templeton addressed the question of how to pick the best stocks within a portfolio. This is a simple and cogent outline of the methods that he was to refine and develop over the rest of his career as a professional investor. As it grew, his investment counseling firm was to devote increasing amounts of time and effort to analyzing and selecting individual stocks. Noted in particular was the emphasis on looking at both value and growth criteria, and the idea that the most successful investments are likely to be those that are unpopular at the time they are purchased. Yet even at this early stage in his career, it was evident that his investment style could not be classified as either a simplistic value or growth approach. He was clear, for example, that stocks with very high dividend yields, one measure favored by value investors, were less likely to produce good results than lower-yielding stocks with superior growth prospects. It is probably worth remembering that at the time the terms value and growth did not carry the same connotations as they do now. For Templeton, it was quite likely that he describe a stock as value because he was underpaying for its growth. In recent years, there has been an obsession with style, which seeks to categorize investors according to the types of stocks in which they seem to invest. This is the antithesis of the approach suggested by Templeton. Which are the best stocks? Letter to Clients, December 1950. After an investor has decided the percentage of total funds which he should keep in common stocks, then he faces the problem of selecting the best stocks. The investor does not wish to purchase a list of stocks selected at random, but rather he wishes to purchase only those stocks which are the best. Some people, especially institutional investors and trustees, use the words best stocks to mean stocks of high investment quality. Stocks of high investment quality are those having a tendency to rise very little in favorable markets and to decline very little in unfavorable markets. These are usually stocks of large and famous corporations, having a long record of steady dividends. It is a simple matter for an experienced investor to make a list of those stocks having high investment quality. There is little disagreement among security analysts in determining which stocks deserve this rating. Other people use the words best stocks to mean stocks having a good short-term outlook. In fact, this is the viewpoint most frequently used in selecting stocks. A stock may be selected because the company is expected to pay an extra dividend, because the company is expected to have an increase in sales volume next year, or because of a rumor that the stock may be split. This tendency to emphasize the temporary outlook is the cause for the wide fluctuation in price which most stocks undergo every year. Now, when we use the words best stocks, we mean simply the best values. That is to say, those stocks whose market prices are lowest in relation to their intrinsic value. The question of investment quality and the question of short-term outlook are only two among the multitude of factors which must be computed and combined in the complex task of estimating the intrinsic value. For each stock we arrive at a specific estimate of intrinsic value. These estimates are kept up to date by frequent review. Each month the market price for each stock is compared with the estimated intrinsic value of that stock. When the market price for a particular stock rises above intrinsic value to an unreasonable extent, we notify clients holding that stock and suggest that the stock should be sold. Conversely, when the market price falls below the intrinsic value for a particular stock to an unreasonable extent, we put that stock on a list of stocks which can be recommended to clients for purchase. To appraise the value of a stock, the analyst must consider not just one or two, but all factors. Some of these factors are management ability, growth trend, government control, assets per share, average past market prices for the shares, dividends, current earnings, average earnings in previous years, estimates of future earnings, and so forth. The appraisal of value is complex and subject to numerous uncertainties. It should not be expected that all selections made on this basis or any other basis can prove successful. But although the intrinsic value is only an estimate, the person or company whose studies are crystallized logically, systematically, and consistently into a specific estimate has an advantage over other stock purchasers and sellers whose ideas are often nebulous and incomplete. A comprehensive and systematic analysis reduces the human tendency to overemphasize one or two dramatic factors and overlook others. The investor who purchases a stock because of basic value can enjoy a certain peace of mind. If after purchasing a stock at a low price in relation to value, the price continues to decline, then it is simply a better bargain than it was before. On the other hand, the speculator who purchases in the hope of a quick profit places himself at the mercy of market fluctuations because he can succeed only by selling his shares to other speculators at higher prices. The investor who selects stocks on the basis of long-term intrinsic value must expect certain problems. In the first place, he should expect usually to purchase stocks which are thoroughly unpopular. Only when a stock is unpopular is the price likely to be depressed greatly below intrinsic value. It is not easy to act contrary to popular opinion. When the price of a stock is very low, there are usually obvious reasons which have caused others to sell the shares and thereby depress the price. For example, after the Japanese attack at Pearl Harbor, the outlook for the automobile industry was recognized as unfavorable. It was widely predicted that the manufacture of automobiles might be stopped completely. Shares of General Motors sold as low as 28 5/8. The manufacture of automobiles was in fact stopped completely a few months later and not resumed for several years. However, the bargain hunters who were willing to act against public opinion and purchase General Motors below 30 after Pearl Harbor were well rewarded because the shares were later split 2-for-1 and are now selling at 47. In the second place, the investor who selects stocks on the basis of long-term intrinsic value should not expect that the stocks selected will immediately begin to show a profit. If the intrinsic value of a stock is estimated at $40, and then over a period of years unfavorable news depresses the price to $20, the investor may begin to buy this stock because it appears to be one of the best bargains in the market. However, it would be an unusual coincidence if he should happen to make the purchase just at the time when the downward trend is reversed. Ordinarily, the downward trend persists for at least a few weeks and sometimes much longer. The investor may hold the shares for a long time before others begin to recognize the intrinsic value. Usually a stock selected for purchase because its market price is very low in relation to intrinsic value sooner or later attracts public favor so that the market price rises above intrinsic value. Even if the stock does not become popular, however, the investment may prove lucrative in the long run. For example, if you can purchase at $20 a stock having $20 a share in assets, earning 20% annually on assets and paying out half of earnings, then simply by holding this stock for 5 years, you will receive more than $10 in dividends and more than $10 in the form of increased assets per share. In other words, you may obtain even 100% profit on the investment even though the stock continues to be unpopular and sells equally low in relation to earnings, dividends, and asset values. Whenever you can buy a large amount of future earning power for a low price, you have made a good investment. In 1954, Templeton wrote a letter to his clients expanding on his view that the worst way for any medium to long-term investor to generate income from his investments was to buy the highest-yielding shares in the market. He made the case for buying growth stocks instead, underlining the handsome results that could be obtained by buying and holding stocks with the greatest potential for dividend growth. This is further evidence of how, although he is known as a value investor, Templeton's methods were more subtle and less easily classified than that description implies. The notion of intrinsic value comes straight out of Ben Graham's security analysis. Yet John Templeton was never a simple follower of the deep value, backward-looking methods made famous by Ben Graham. From an early point in his career, he was looking for the stocks that were going to produce the greatest total return over a period of years. Implicit in this approach was the need for investors to be patient and wait for the returns to come through. How to increase your income from investments. Memorandum to Clients, February 15, 1954. Any good investment research man can prepare for you within a few minutes a well-diversified list of stocks yielding over 10%. On the basis of market prices on February 10th and the dividends paid in the last 12 months, Van Norman Company yields 10.5%, Moore McCormick Lines 11%, Barker Brothers 11.7%, Pond Creek Pocahontas 11.9%, Butte Copper 12.3%, Nash Kelvinator 12.8%, Pacific Tin 13.0%, Great Northern Iron Ore 13.0%, Inspiration Consolidated Copper 13.1%, and Roan Antelope Mines 15.6%. These are all well-established corporations with shares listed on the New York Stock Exchange. This is an easy method for increasing your income from investments, but it is the worst of all methods. Stocks sell at low prices in relation to current dividends, usually because there are good reasons for expecting that the dividend may be reduced. Investors selecting stocks with high current yield face not only the risk of reduced dividends, but also the greater risk of capital losses. A far wiser method for increasing your income is to select stocks with the highest earnings in relation to market price. This will usually mean that your stocks have good prospects for paying increased dividends rather than prospects for paying reduced dividends. Many good stocks can now be found whose annual earnings are more than 15% of the market price. Such earnings are partly reinvested by the company for the benefit of stockholders, which, in turn, leads to still higher earnings per share in future years. Of course, in seeking such stocks, you should skip those whose earnings are high for 1 or 2 years for abnormal reasons, and search rather for those likely to have a high level of earnings for many years in the future. In the endeavor to increase your income, it is wise also to select growth stocks. Growth stocks are most likely to earn more and pay increased dividends in future years. Usually, growth companies have a high rate of earnings in relation to net worth. By retaining a large share of its earnings each year, a growth company may be able to double its net assets per share within a relatively few years, and this in turn may lead to increased earnings and dividends. Another sound method, with which our clients are thoroughly familiar, is to reduce the percentage held in common stocks when the stock market rises far above normal, and then in turn to increase the percentage in common stocks when the stock market declines far below normal. At first thought, it may seem strange to speak of increasing your income by taking part of your money out of common stocks when stock prices are high, in order to create a reserve of top-grade bonds, which usually have low yields. However, the importance of having a reserve and the use of such reserve to achieve an increase in income will become apparent the next time common stock prices are really low. Then the reserve can be used to purchase more common stocks at prices that are really low in relation to probable earnings and dividends of future years. For example, let us assume that the stock of X company is paying, and will continue to pay, $1.50 annually in dividends. It may be possible at some time to sell such a stock at $30, hold the proceeds temporarily in 3% bonds, and then within a few years use this reserve to repurchase at $20, 3 shares of the same stock for each 2 shares previously held. This method accomplishes no temporary increase in income with accompanying risk, but rather a solid and permanent increase of income in the long run. For the purpose of increasing your income, constant watchfulness is also important. Prices of common stocks fluctuate very widely. It is often possible to sell a stock whose price is too high in relation to value and use the proceeds for the purchase at the same time of another stock whose price is too low in relation to its value. Transactions which increase the intrinsic value of your list of investments usually lead to increases in income in the long run. The Templeton, Dobro, and Vance Model Fund, which started September 30th, 1943, can serve as an example of the increased income resulting from the methods mentioned briefly in the 4 preceding paragraphs. This fund started with a capital of exactly $100,000. And although it is only 68% invested in common stocks, it is now earning income at the rate of $11,213 annually, or 11.2% of cost. As one more example, consider the case of Mr. M., whose fund of $276,000 was first placed under our investment council management exactly 15 years ago. Although this fund is now only 57% invested in common stocks, the income is $30,780 annually, which is 10.9% of cost. By using the methods mentioned above, you may increase your income on a sound and permanent basis. Also, these methods should increase both the safety and the capital growth of your investments. As noted earlier, it should never be forgotten that John Templeton was not just a successful investor, but a shrewd businessman who, it is clear, was always alert to ways of maximizing the value of his investment counseling business. The following memo that he wrote to his colleagues contains some important advice on the subject of how to keep clients happy. To modern eyes, the word indoctrination may carry connotations that were almost certainly not intended at the time. Securing customer loyalty would, we suspect, be a less pejorative phrase to describe the firm's sensible business objective of retaining the goodwill and custom of its clients. Memo to Liddell, Scott, Hevner, Palmer, Warner, Andrews. Dated December 1953. Allen has suggested that it might be helpful to all of us if I would try to put down on paper the thoughts which I have developed in the last 12 years on the subject of how to keep a client happy. Actually, my knowledge on this subject is inadequate, and I think that many of you have more aptitude than I. It is a difficult subject because it seems to me that the influences on the psychological attitudes, decisions, and beliefs of human beings are 90% subconscious and only 10% logical. However, any personal service firm must devote much effort and thought toward continual indoctrination and selling of the clients, and therefore I will set down below a sort of checklist which may be especially helpful in the work of indoctrinating new clients and others. 1. Most important of all, the investor wants to feel that his list of stocks is the best which could possibly be selected. If he is thoroughly convinced on this score, price fluctuations will appear to be opportunities rather than causes for concern. The best means is to have a long personal talk with a client about each of his stocks at least twice a year. If you explain in great detail why each stock is good and what methods we use in selecting stocks, a client will be happy with his list and will probably be impressed with your wide knowledge. Clients like to know that each of their stocks is subject to continuous restudy and follow-up. 2. The investor will be comfortable if he knows that he is following a sensible program. In each interview, and often by letter, it is often wise to describe the program he is following. He wants to feel that his program has been carefully prepared with regard to his own particular needs, and that improvements are made frequently. He should understand the reasons why his program is likely to prove not only safer, but also more profitable in the long run than any other possible program. Clients usually like to know how many institutions use this non-forecasting method. Some counselors make a special point of the various ways in which they have diversified the client's holdings. 3. The investor wants to feel that his affairs are managed by a group of wise and prudent men. No one of us would want to say this about ourselves. However, each of us should seek opportunities to describe to the client the background and wisdom and success of each other man in the organization. Some counselors make a specially strong point of the fact that other sources of advice may be biased, whereas investment counsel works in the client's interest only. 4. It is human to be subconsciously influenced by appearances. Those banks which inhabit marble palaces usually attract the most customers. This means not only appearances of officers, but also size of organization, age, clothing, automobiles, stationery, telephone handling, booklets, and many other things. The feeling of optimism and prosperity is contagious. The counselor whose manner and words reflect uncertainty or disappointment will quickly give the same feeling to the client, and the counselor whose manner and words reflect confidence and prosperity will quickly give the feeling of confidence to the client. 5. The majority of clients are interested in safety of income and growth of income more than anything else. We should make this a major point in talks with clients and in letters. For example, we should show a client not only the income percentage based on current market prices, but also the percentage based on capital originally listed with us. 6. Clients are also interested in capital gains, some more and some less. Trust companies and most large investment counsel ignore this subject completely, but in my opinion we should not overlook an opportunity to point out a good capital gains record. From experience, it appears that the client is most influenced if his record is compared with that of some other investor or firm of high reputation. There is a wide variety of methods for comparing capital changes, some of which were listed in the memo I wrote a couple of years ago concerning the results letters. 7. Each of us should keep in mind the strong psychological effect of repetition. Pointing out a good record once does not have nearly the effect of pointing out the same record 4 or 5 times. Contacts with clients week after week which report mostly items of important news about their stocks have a cumulative subconscious favorable effect, whereas a series of letters or contacts which mention problems have the opposite effect. Because of repetition, the question of having investment counsel costs paid by the custodian has utmost importance. Trust company costs are seldom mentioned by beneficiaries because they never see the bills or make out the checks. However, although no client minds paying the first bill, he does build up a subconscious sensitivity by having to make out a check every 3 months for an amount which is usually one of his largest expenses. 8. Intimate knowledge of every detail of family affairs is a proper expectation of the client, because investment counsel does fit selections to the needs and wishes of the particular client. If the counselor remembers most of the details about the family, taxes, and investment holdings of the client, this gives the client a feeling that he is getting close, personal attention. Estate planning is a helpful thing in establishing this close relationship. Personal friendship should be cultivated in various ways because this subconsciously encourages a favorable attitude toward each question that may arise. 9. To some extent, clients are happy to learn how good our record has been for other clients. The model fund is a help in this respect and should often be shown to the clients and the method of comparison described in some detail. Testimonial letters are helpful also. 10. Frequent mailing of reports and studies gives the client a better understanding of our work. This helps the client to learn how much research and thoughtful work in many fields is devoted to his financial welfare. This sort of memo is especially helpful to keep in touch with prospective clients. 11. We should explain much more often than we do just how much more the client owns in terms of earning power per dollar invested and real value per dollar invested than he had when he came with us. When recommending switching from one stock to another, we should often give a tabulation of 5 or 6 reasons with figures showing just how the stock purchased is better than the stock sold. Reading through the letters to clients shows, as you would expect, that the markets were not the only concern of the firm. The principals also tackled more mundane issues such as tax and legacies. They became early advocates of profit-sharing plans for employees. For all his success in building a profitable investment counsel firm and taking a prominent role in the campaign to raise awareness of the new profession, it is clear that by the end of the 1950s, John Templeton was beginning to think of his next move. His experience in setting up and advising investment funds, which had begun some 8 years earlier, coupled with his awareness that the world was undergoing far-reaching changes, creating new opportunities for investors, was to persuade him that the time had come to sell his advisory business and concentrate his efforts on the attractive and fast-growing business of fund management. Looking back later, Templeton regrets that he took so long to realize the value of going into mutual funds. "I was much too late into it," he said in an interview with the authors in 2003. "If I had been wise, I would have started much sooner. But I noticed that the people who had started mutual funds were getting more clients and more money than I was. At that time, there were tax advantages in having a fund incorporated in Canada, so I formed the Templeton Growth Fund of Canada. It was available to Americans as well as Canadians. However, it was 1954 before I had any fun, and even then, I didn't have salesmen. That was my major mistake." Quite a costly mistake that proved to be, and it is addressed in the next chapter, which looks at his record as a fund manager. Chapter 3. Fund Manager. In this chapter, we look at John Templeton's long career as the manager of mutual funds and attempt to answer a fundamental question: how good was he as an investor? During his lifetime, he received numerous accolades. Forbes magazine, for example, described him as one of the handful of true investment greats in a field of crowded mediocrity and bloated reputations. Another financial magazine went further, describing him as the greatest stock picker of the century. In Money Masters, John Train's popular book about the giants of the late 20th century investment business, it is the track record of the Templeton Growth Fund which, he concludes, proved that John Templeton is one of the great investors. Ken Fisher, CEO of Fisher Investments, says, "To say Sir John is legendary is an injustice to the word legendary." Such accolades slip easily into print, but how well justified are they? To answer that question, we focus on the performance of the Templeton Growth Fund, which was launched in 1954 and still exists today. Although he had previously created other mutual funds and was later to launch others with similar objectives, the Templeton Growth Fund, TGF, is the one that was responsible, after flying under the radar for many years, both for establishing his reputation as an outstanding investor and for laying the foundations of his substantial personal wealth. This in turn made possible the great majority of his many charitable and philanthropic activities. The critical importance of this one fund in shaping his life was something of which Templeton himself was acutely aware, and to which he frequently referred in later years. As we noted in the previous chapter, Templeton was happy to admit in later life that his biggest regret was not getting into the fund management business earlier. When a young English fund manager traveled to the Bahamas in the early 1990s to ask Templeton for advice on how to succeed as a professional investor, he put a simple question: "Sir John, what is the most important single lesson you have learnt in your long career?" To his surprise, The answer that came straight back had nothing to do with the finer points of stock picking or any other aspect of security analysis. Instead, said Sir John, his answer would be the importance of distribution, by which he meant the ability to put his funds into the hands of as many investors as possible. The reason for his regret, in other words, was that the economics of the fund business were so clearly superior to that of his earlier profession of investment counseling. Looking at the data for the performance and size of his flagship fund over the course of his 38 years as a fund manager makes clear the truth of this comment. His involvement in mutual funds had begun, as we have seen, in the early 1950s. The Templeton Growth Fund, launched in 1954, was one of 5 mutual funds, according to a 1959 press article, in which he was involved in one capacity or another by the end of the decade. The 5 included the enticingly named Nucleonics, Chemistry, and Electronics Shares Fund, set up, one assumes, to try to cash in on investors' enthusiasm for the new technologies and industries that were emerging after the war. Even in its infancy, the mutual fund business was never slow to spot commercial opportunities for selling shares in funds that invest in new growth industries. In 1958, Templeton joined forces with William G. Damroth, a sales and marketing professional and author of a self-improvement title, How to Win Success Before 40, to issue shares in a joint venture management company, the Templeton Damroth Corporation. Asked to justify the hefty front-end sales charges, loads, Templeton commented that in his experience, no-load funds, although cheaper, simply do not grow because few investors take the time to find out about them. It is clear that Templeton was aware of the importance of marketing his funds, but success seems to have been elusive. While in his public speeches and in the media he invariably described himself in this period as an investment counselor rather than as a fund manager, it is evident that he was well aware of the potential rewards of expansion into mutual funds. Few businesses, he was quoted in an article as saying, had better growth prospects. The Templeton Growth Fund was a conscious effort to broaden the base of investors who wished to tap into his firm's investment expertise. It was also, just as importantly, one of the very first mutual funds to offer investors in North America the opportunity to invest in a diversified portfolio of non-U.S. stocks, something which, for both cultural and legal reasons, investors at the time rarely chose or were able to do. For tax reasons, the fund was initially domiciled in Canada, and for its first few years the portfolio consisted mainly of Canadian stocks and bonds, although the fund from the outset had a mandate to invest up to 1/3 of its capital outside Canada and the United States. The launch followed hard on the heels of a ruling by the Securities and Exchange Commission in April 1954, which for the first time permitted the sale of shares in Canadian domiciled investment trusts to U.S. investors. Because the fund paid no capital gains tax, and the fund's initial policy was not to pay dividends, thereby avoiding income tax, a key selling point of this and other funds like it was that they offered U.S. investors the opportunity to roll up gains from Canadian and other global equities free of tax. Gains were only taxed, at the rate of 25%, when an investor sold shares in the fund. The SEC ruling was one of the seeds from which the multi-billion-dollar global fund management industry we know today was eventually to grow. Market beginnings. Templeton continued to manage the Templeton Growth Fund for 38 years after its launch. An extract from the first annual report of the fund is reproduced in the appendix. Templeton, Dobro, and Vance appears as the fund's investment advisor and Templeton himself as president and a member of the 12-man board. The first annual report notes how, by April 30th, 1955, 2 months after the closing of the public offer of shares, the number of shareholders had increased from 493 to 1,060, and the number of shares outstanding from 302,000 to 340,000. It was a relatively modest beginning. The gross underwriting fee paid to White Weld, as underwriter of the public offer, amounted to 5% of the $6.6 million raised. As the investment advisor, Templeton's investment counsel firm was paid an annual management fee equivalent to 0.5% per annum for the first $10 million of assets, reducing to 0.375% for the next $10 million and 0.25% when and if the fund reached $20 million in assets. At the balance sheet date of April 30th, 1955, the fund's net asset value had risen modestly from $20 per share to $20.89 in U.S. dollars. Just over 60% of the fund was invested in equities, 18% in preferred stock, and around 20% in fixed interest securities, including Canadian and UK government bonds. The report listed holdings in 27 Canadian equities, of which around a third by value were in forestry and mining. Overall, Canadian assets accounted for 90% of the fund's net worth. Subsequent annual reports track the steady continued appreciation in the value of the fund, while simultaneously underlying the slow, indeed snail-like, not to mention periodically negative, rate of growth in the amount of money in the fund, the issue that was to cause Templeton so much future regret. In 1957, for reasons that remain unclear, but presumably in an effort to increase sales, the fund was briefly renamed and reconstructed as the Axe Templeton Growth Fund of Canada, with shares now being marketed on a continuous basis through a network of investment dealers organized by a Canadian advisory firm, E.W. Axe and Company, which also joined Templeton, Dobro and Vance as joint investment advisors. As a result of the reconstruction, more than half the shares in the fund were redeemed, and the net assets of the firm fell to Canadian $2.9 million, of which more than a third was owned by the directors and others associated with the fund. The net asset value per share also fell. A contemporary book about the investment industry in Canada in 1958 lists more than 30 funds primarily owned by investors from the United States. Only one has fewer assets than the $4 million in the Templeton Growth Fund, while several are 5 or 10 times as large. It was not until the early 1960s, around the time that Templeton sold his investment counseling firm, that the arrangement with E.W. Axe was unwound, and Templeton resumed his role as the sole investment advisor of the fund, this time through a new management company, Templeton Management Limited. The 1965 annual report of the Templeton Growth Fund notes that the net asset value of the fund, now $15.14 Canadian per share, was more than 3 times the initial issue price, adjusted for subsequent share issues and redemptions. Yet the net assets of the fund were still only $4.7 million Canadian, barely 70% of the amount initially raised more than 10 years before. To make things worse, shares in the fund were no longer being offered directly to U.S. citizens, following a recent decision by the U.S. Treasury to tax purchases of foreign securities by U.S. citizens. A new Canadian withholding tax on the fund's non-dividend income was also creating some difficulties, requiring the fund to make up the difference to shareholders and then create a reserve, which had the effect of reducing the net asset value. Despite its healthy investment gains, in other words, the first decade of the fund's life left a good deal to be desired in commercial terms. The only consolation by the mid-1960s was that Templeton's investment advisory fee from the fund had risen to $21,000 a year. By the end of the decade, this had risen further to $30,000 a year Canadian. Yet the same pattern of continued investment advance, coupled with modest asset growth, remained. By the time of the 1969 annual report, net assets had risen to $6.8 million Canadian, despite the fact, as Templeton pointed out again in his cursory statement to shareholders, that the value of shares in the fund were now 5 times what they had been at launch 15 years before. Out of 1.79 million shares issued, more than 1.5 million had been redeemed. meaning that the number of shares in issue was also lower than at the outset of the fund 15 years before. As a result of the redemptions Templeton disclosed, he himself now owned more than 10% of the shares in the fund. If nothing else, Templeton Management Limited was being paid well for looking after his own money. Yet if Templeton was ready to sell the fund at the time of his move to the Bahamas, as we now know he was, it would hardly have been a surprise. The sparseness of his letter to shareholders, 8 short sentences, amounting to barely 100 words in total, a fraction the length of his first annual report statement in 1955, could be interpreted as suggesting he may well have been losing interest in the fund business. Changes in the portfolio. What had clearly changed by the 1960s, however, was the composition of the portfolio, reflecting Templeton's growing interest in international diversification. In his 1967 letter to shareholders, he noted that the 12 largest common stock investments in the fund now included 2 companies from Holland, Phillips and Royal Dutch Petroleum, and 1 each from Japan, Germany, Sweden, and Great Britain. Other than Canadian government bonds, the largest single holding in the fund was Shiseido, a Japanese cosmetic company. It was the only Japanese stock in the portfolio, but it amounted to 13% of the total value of the fund. The fund in 1967 also owned a series of German and Japanese bonds. Overall, however, the fund had fewer than 30 investments. Pointers to Templeton's maturing style as a fund manager, the global focus, the concentration on high-conviction ideas, and the willingness at times to hold high levels of liquidity in the shape of government bonds were nevertheless beginning to become apparent. 2 years later, in the 1969 report, around the time that Templeton and his wife were packing their bags to live full-time in the Bahamas, the pattern remained broadly similar. Shiseido, the Japanese cosmetic company, was still the largest single holding, now up to 14.5% of the fund by value, followed by Ericsson, the Swedish telecom manufacturer. The holdings of foreign and government bonds accounted for more than 1/3 of the value of the fund, reflecting Templeton's concern at the heightened valuations in equity markets prevailing at the time. Given the size of the fund, he could not, it seems, find more than 20 individual stocks anywhere in the world that met his demanding valuation criteria. Much has been made in profiles and biographies of Templeton's brilliant and contrarian move to take big bets on unfashionable Japanese stocks from the 1960s onward. His coup in finding fast-growing Japanese stocks that were trading at ridiculously low P/E ratios features prominently in published accounts of his life and career. In fact, Templeton himself had already started to buy Japanese shares for his own account through a broker in the mid-1950s. His clients were also being alerted to the potential in Japan as early as the late 1950s, well before the strength of the post-war Japanese miracle had come to be appreciated by investors in the West. In May 1959, for example, Templeton wrote a long memo to clients pointing out the success that Japanese companies were having in winning export business in the United States and Europe. He pointed out that bonds of good Japanese companies could be bought for twice the yield on similar U.S. issues, 8% against 4.2%, while stocks yielded 1% more than the Dow Jones Industrial Average. Further, he noted that although there were still at that time restrictions on repatriation of capital, the Japanese did not impose a withholding tax on dividends remitted by Japanese companies to U.S. shareholders, meaning they were taxed less heavily than dividends from American corporations. In addition, he pointed out, just 1.59% of Japanese shares were owned by foreigners. The 5 stocks he recommended to his clients in 1959 were not, however, at least ostensibly, the dirt-cheap growth stocks in which his fund was to invest in years later. All 5, Toyota, Matsushita, Sanyo, Ankyo, and Riken Optical, were trading, according to his memo, on multiples of between 15 and 20 times earnings. Although they had useful dividends, they would not have been obvious bargains to a traditional value investor, at least until it was possible to dig deeper, as Templeton was able to do, into the question of how Japanese accounting rules affected the reported figures, which in many cases had the effect of disguising the true level of profitability. If he had already identified the way that accounting treatment was disguising the true rate of profitability of these companies, it seems logical to expect that he would have mentioned it in his memo. But he did not, implying that this realization was only to come later. Yet, as we have seen, if Japanese stocks were attractive, they did not, apart from Shiseido, figure prominently in the Templeton Growth Fund portfolio until the early 1970s. The important point was that he was more than willing to extend his search for bargains to countries that many other investors at the time were either unwilling or unable to consider. As early as 1955, Templeton had sent a series of letters to clients describing his impressions after a trip to Europe, and in 1959 he repeated the exercise after a 17-day visit that took in 6 different countries in Europe. Travel and study of stocks and bonds in other nations, he observed in one letter, serves 2 purposes. Firstly, it leads to discovery of attractive opportunities in the securities of those nations. More importantly, a study of the exotic conditions and investment trends in other lands helps us to understand more clearly what can happen in our own nation. It teaches us to question the economic theories and fads popular here. It gives us deeper respect for the fact that the most unexpected things can happen and often do. It was from this and his earlier experience that he began to list the distinctive qualities that made one country rather than another suitable for outside investors. In Japan, he saw a politically stable society that was making a determined effort to recover from World War II and recognized in the country's people many of the characteristics, hard work, respect for business, thrift, that he most admired and looked for when considering new countries in which to invest. Although he invested personally in Japanese stocks, the main obstacle to the fund investing in Japan was its restrictions on capital repatriation, which were not fully lifted until the second half of the 1960s, following Japan's admission as a member of the OECD. Capital controls were one of several barriers that tended to make a country unattractive as a place to invest in. Others included lack of respect for property rights, populist governments, and socialistic tendencies. Great prosperity only occurs when people are free. If we regulate people excessively, we slow down and perhaps prevent, even reverse, the trend towards prosperity. With the exception of Shiseido, it was not until 1971 that Japanese stocks began to appear prominently in the Templeton Growth Fund. It did not take long for the boldness and wisdom of his move to become apparent. At its peak in 1974, no less than 62% of the fund by value was invested in Japanese shares. Contrary to mythology, many of the most famous Japanese exporters of the time, such as Canon, Toyota, and Sony, never featured in the portfolio. In absolute terms, the fund's largest single gains came from Sumitomo Trust, a bank, and Bridgestone, the tire company, and from the bonds, not the shares, of Nissan. Drug companies were a particularly strong favorite. Most of the purchases were made in 1972 and 1973, and by 1975, having made significant gains on many of them, Templeton was already turning his attention back to the U.S. stock market, where the market crash was beginning to offer superior bargains. By the time of the 1978 annual report of the fund, the proportion of the fund in Japanese stocks had fallen to less than 10% of the portfolio against 42% in U.S. stocks. This was a trend that was to continue well into the 1980s. Several different factors, it is clear, were in Templeton's mind at the time of his initial Japanese purchases. It was not just that the stocks themselves were very attractively priced and potential bargains in his way of thinking. Because the fund was so small and effectively operated without any investment constraints, he was free to make what conventionally would be regarded as an extraordinarily risky concentrated bet on stocks of just one country. Just as important, however, was the fact that by the late 1960s, the stock markets in the United States and the United Kingdom were becoming excessively overvalued in the face of what, it was soon to become clear, was the worst economic crisis the West had faced since World War II. Share prices hit a peak in 1972, but were soon to experience heavy falls as the full impact of the OPEC oil embargo and the inflationary pressures which had been building for many years finally took their toll on economic growth and corporate profitability around the world. The Dow Jones Index, already seriously overvalued, fell 45% between January 1973 and its nadir in December 1974, and the London market by an even greater amount. If Templeton had not felt that most U.S. and European stocks were seriously overvalued, it is unlikely that he would have allowed his Japanese holdings to become such a dominant component of his fund's portfolio. Japan was to suffer more than most countries from the impact of soaring oil prices, yet the growth fund's Japanese stocks were protected from the worst of the decline by virtue of being so cheap at the point at which they were bought. What he liked about the shares, it seems clear from studying the pattern of his holdings over these years, was not their growth rates, but simply the fact that they were selling on such low multiples of earnings. If ever there was an illustration of one of his core ideas as a fund manager, that the shape of a portfolio should be driven by where cheap stocks were to be found, not by preset limits on how much could or should be held in this or that country, or this or that industry, the experience of the early 1970s provided it. The big weighting in Japanese stocks helped the fund to an exceptional 68% gain in the calendar year 1972, the final peak in the global stock market cycle, although it could not prevent the fund losing money in both 1973 and 1974, albeit at a slower rate than the world index. Over the 3 years 1972 to 1974, thanks mainly to the Japanese equities and bond holdings, the Templeton Fund outperformed the market by more than 60%. And crucially left investors still sitting on longer-term gains during a period when the average investor holding the world market index was facing significant losses. When the Japanese stocks owned by the fund returned to more normal multiples, Templeton sold them, only to see them rise even further as Japanese shares were re-rated to much higher multiples. This turned out to be a move from which the growth fund, ironically, largely failed to profit. By the end of the 1970s, the Japanese stock market, on conventional analysis, was already selling at 3 times the price-earnings ratio of the U.S. stock market. The Glory Years. The early 1970s, although one of the darkest periods in recent economic history, proved in hindsight to be the period in which the fortunes of Templeton and his fund finally took off. This success was driven by 2 new factors. One was the fact that his performance as fund manager improved dramatically after his move to the Bahamas. Templeton discovered that working alone, hundreds of miles from the daily dramas of Wall Street, produced an extraordinary improvement in his ability to pick stocks. The 2 decades that followed his move, even with only 1 or 2 hours a day in which to conduct research, gave full flower to his genius as a stock picker. They were the making, quite deservedly, of his reputation as one of the greatest investors of the century. The move into Japanese stocks was the first of many such moves that revealed both the rigor and the boldness of his methods. The second new factor was the one that was to turn the improved performance of this tiny and still largely unknown fund into a formidable cash generation machine and the bedrock of a global fund management business. As described in Chapter 1, the turning point came in 1974 when a former accountant and airline pilot named Jack Galbraith agreed to take on the task of marketing the fund full-time. It was only now that the fund as a business began to grow rapidly, as the effect of Galbraith's simple but effective sales and marketing efforts began to bear fruit. In 1974, 20 years after raising $7 million at its launch, the fund still had just $13 million in assets. Adjusted for inflation, the fund had barely grown at all in over 2 decades. It still had fewer shares in issue than when it started. This was not because the fund had failed to deliver good performance. On the contrary, the capital value of the fund had grown 9-fold in the first 20 years of its existence, a compound rate of return of around 12% per annum. The modest size of the fund at this point was a testament both to the trough into which the stock market had slumped in the mid-1970s and the fund's almost total lack of marketing presence. It remained so small that it barely figured on investors' radar. The figures show that the fund suffered regular redemptions throughout its first 2 decades. Although the fund was producing good returns, it is clear that many investors failed to appreciate what a potential gold mine they were sitting on. Under Galbraith's energetic leadership, the subsequent growth in the fund was striking, underlining the scale of the opportunity that had been lost for so many years before. His approach was simplicity itself, a heavy focus on the extraordinary track record of the fund, combined with the payment of hefty upfront sales commissions, typically as much as 7%, and an active PR campaign, including the first of what were to become regular appearances by Templeton on the popular TV program Wall Street Week. Within 4 years, the assets in the fund had grown more than 7-fold to reach $100 million. By 1980, net assets had reached $420 million Canadian, or more than 40 times the size of the fund 10 years earlier. With the onset of the great global bull market that developed during the 1980s, it was not long before the size of the fund was being measured in billions rather than millions of dollars. By 1986, the fund had reached $2.4 billion Canadian, at which point Galbraith recommended that the fund should be split in two, to allow for the launch of a sister fund, this one registered in the United States rather than Canada. Following the split, 42% of the assets remained in the Canadian entity, with the balance accruing to the U.S. counterpart, which continued to invest in exactly the same way. A change in the U.S. tax regulations, this time the introduction of a foreign tax credit on overseas investment, was an important trigger for this move. The evidence of Galbraith's market efforts were to be seen in many ways as the fund grew. The annual reports became both more comprehensive and more boldly illustrated. Each one now invariably appeared with a graphic representation of the mountain, showing how far and how fast an original investment in the Templeton Growth Fund would have grown since launch in 1954. The fund continued to levy exceptional upfront sales loads, equivalent to as much as 7.75% of the amount initially invested. So strong was the track record that these hefty upfront charges proved no obstacle to further sales growth. Of necessity, as the cash flowed in, the number of investments held in the fund grew accordingly. By the time the 1985 annual report was issued, the fund had more than 115 individual securities, spread across 4 continents and 21 different industrial categories. The largest single holding in 1985, American Stores Incorporated, nevertheless still accounted for 7% of the common stock portfolio, a sign that despite its rapid growth, Templeton was still prepared to place sizable individual bets on companies that met his valuation criteria. A year later, in April 1986, the annual report indicated that Templeton was becoming concerned about the extent to which the bull market had run ahead of itself, driving valuations to excessive levels. His strategy as a fund manager from the outset had been to build up holdings of bonds and cash whenever his analysis suggested that equity markets were rising above their normal levels. The same discipline that had underpinned his approach to managing clients' money in the 1950s persisted into his career as a fund manager. While the 1986 annual report makes no mention of the newfound caution, it is evident in the balance sheet of the fund, with bonds, preference shares, and treasury bills amounting to no less than 28% of the total portfolio. Some of this can doubtlessly be attributed to the sheer scale of money flowing into the fund. The following year, with the reporting date now the end of August, the U.S. fund was still reporting 16% of its holdings in bonds, cash, and preferred securities. Less than 2 months later, the October 1987 crash produced the most traumatic two-day decline in stock market history. Having lagged the market index for several months, Templeton's caution and refusal to overpay in the frothy market that had developed in 1987 once again propelled his fund back into the ranks of top performers. On this occasion, however, his superior performance was not to endure for long. While it remained an extremely profitable home for fund investors' money, the second half of the 1980s proved to be the worst period of relative performance the fund was to endure in its 50-year history. The reason was simple. These years marked the tail end of the great Japanese stock market bubble, which by the end of the decade was to take the market capitalization of the Tokyo stock market to 40% of the world index, the benchmark against which global equity funds were generally measured. Templeton's refusal to pay the absurdly high prices for Japanese stocks that this implied meant that his relative performance was bound to suffer as the Japanese market climbed ever steadily higher. From 1987 onward, the Templeton Fund had no holdings at all in Japan. It was only after 1989, when the Japanese market finally peaked, that the wisdom of Templeton's refusal to breach his principles became apparent. He was right that the market had become overvalued, but from the perspective of anyone tracking short-term performance, his decision to abandon the Japanese market was way too early. In that sense, Templeton's involvement with the Japanese stock market turned out not to be his finest hour, but ironically one of his worst moves. The changes in the makeup of the portfolio that characterized John Templeton's time in charge of the fund are as follows. From 100% in 1959, the equity component fell to as little as 63% in 1969, as he became increasingly nervous about the level of market valuations. These were the so-called go-go years for the stock market in the late 1960s, when a new breed of gunslinger fund managers burst on the scene, and investors went wild for any company associated with electronics and other new technologies, driving up stock market valuations to unprecedented levels, an uncanny foretaste of the much bigger technology stock bubble which was to follow 30 years later. Comparing this to the equivalent weightings in the MSCI World Index, we can now see how regularly and by how much Templeton's holdings deviated from those of the world market. The relative briefness of Templeton's foray into Japan is very evident. The disparity between fund and index is an inevitable characteristic of the value-driven investment approach Templeton chose to adopt. By the time this became apparent, Templeton's time in personal charge of the fund was coming to an end. With more of the stock-picking already having been delegated to Templeton's assistant, Mark Holowesko, in 1992, Templeton Galbraith Hansberger, as the firm had become, was sold to Franklin Resources, another fund management company, for $440 million. The assets of the fund by now were more than 1,500 times what they had been 18 years before. The effect of Galbraith's marketing efforts had a dramatic impact on the profitability of the Templeton Growth Fund. In 1972, after 18 years in operation, the fund was earning Templeton and his partners the useful but hardly princely sum of $40,000 a year, equivalent to approximately $210,000 in today's money, adjusting for inflation. By the time the business was sold to Franklin Resources, the annual management fee from the U.S. portion of the fund alone was more than $17.8 million. This was 85 times more fee income than the fee produced 20 years before, according to the annual report. And the fee income was still growing strongly. In addition to the management fee charged by the Templeton Management Company, the fund was also paying out more than $3 million a year in sales commission to the Templeton Distribution Company. Although he continued to take an active role in overseeing the investment performance of his various family and charitable foundations, and his views on investment continued to be widely sought, 1992 therefore marks the point at which John Templeton, by now approaching 80 years of age, retired from full-time professional investing. While his investment experience spanned the best part of 8 decades, his professional career as a fund manager and investment counselor can be said to have lasted for 54 years. He continued to make large and mostly successful strategic investment decisions from 1992 until his death, and his views remain keenly sought by the media, but these were mainly on his own account, or for the benefit of his charitable activities, not for the benefit of others in a professional capacity. Performance of the Templeton Growth Fund. There is no shortage of performance data for the Templeton Growth Fund, which, unlike John Templeton's investment counseling firm, remains in existence today. We have continuous daily performance data for this fund from 1954 to the present. The 38 years between 1954 and 1992, during which John Templeton was either directly managing or overseeing the performance of the fund, provide the concrete evidence on which we can judge his success as a professional investor. For many good reasons, care is needed when analyzing fund performance. The fund business has always relied heavily on marketing and sales incentives to win business, and performance claims, naturally presented in the best possible light, are one of the key selling points. For the unwary, interpreting fund performance figures is a hazardous business. What investors think they are buying quite often turns out to be not either what they thought they were getting or what they had been promised. The evidence from an analysis of the performance of the Templeton Growth Fund is clear and compelling, however. Our analysis of the TGF's performance covers the period from 1954, when the fund was launched, to 1992, when the business was sold. In the last 5 years of this period, day-to-day management of the portfolio was in the hands of Mark Holowesko, a qualified investment analyst who had become John Templeton's assistant in the Bahamas 7 years before. From 1987 onward, Holowesko carried out most of the specific stock research and suggested trades for Templeton to approve. He worked in an office down the hall from Templeton's own office in Lyford Key in the Bahamas and talked to him every day, other than those when the latter was traveling. Templeton himself retained overall responsibility for the fund. It was he who set the strategy and was responsible for many of the ideas that were reflected in the portfolio. The most important findings to come out of our analysis of the performance of the Templeton Growth Fund are discussed here. Long-term outperformance. The average 12-month return of the fund in the period 1954 to 1992, measured on a total return basis, was 16.0% per annum. This was 3.7% per annum more than the return offered by the world stock market over the same period. While Templeton was running the fund, in other words, it produced a 12-month return that, on average, was approximately 1/3 as good again as that recorded by the equivalent global stock market index. Few other professional investors have achieved such a consistent, long-term track record of outperformance over a period of so many years. While a margin of 3.7% per annum may at first sight seem a relatively modest level of outperformance, in fund management terms it is anything but. Only a handful of professional fund managers can boast such a record over 10 years, let alone sustain it over nearly 4 decades, as Templeton was able to do. A margin of 1% per annum is typically enough to earn a fund manager a star rating, and 2% per annum, if consistently maintained without the assistance of leverage, is the stuff of which great reputations and great fortunes can be made. So rarely is it achieved in practice. Every year, for example, Standard & Poor's calculates the number of professional fund managers in the United States who have managed to outperform their relevant benchmark on a 1, 3, 5, and 10-year basis. Only a small handful have consistently outperformed the market over a 10-year period, and hardly any have produced a positive real return in every single 60-month period. For many years, as Professor Burton Malkiel noted in early editions of his classic book on the stock market, A Random Walk Down Wall Street, the Templeton Growth Fund was one of the few funds in the entire mutual fund industry that could claim such a long-running record of sustained success. Wealthy, long-term investors. One of the most important benefits that flows from consistently superior fund performance, where it can be found, is that it provides disproportionate rewards to long-term investors, those who have the patience to wait for returns to flow through to their accounts. Many years ago, Albert Einstein described compound interest as the 8th wonder of the world. In investment, the ability to compound positive returns can indeed produce wondrous results, something that the history of the Templeton Growth Fund faithfully illustrates. An investor who committed $10,000 to the fund at its launch in 1954 and held on to that investment for the entire 38 years, during which John Templeton remained in charge of the portfolio, would have had by the end a holding worth $1,736,108, a 170-fold increase in value. A similar holding in the MSCI World Index, had such a thing been possible through all those years, would have been worth $534,907, less than a third as much. An initial investment in the fund would have compounded at the rate of 14.6% per annum over the 38-year period, compared to 11.1% per annum for the MSCI World Index proxy that we use in our analysis. For every dollar invested at the outset, therefore, the Templeton Growth Fund generated a final sum at the date of its founder's retirement that was 3.25 times greater than that offered by the markets in which it was investing. It is true that figures presented in such an impressive fashion can be misleading. As we have seen, by far the majority of the money in the Templeton Growth Fund was invested in the last 20 years of John Templeton's tenure as the fund manager, and so would not have enjoyed the benefits of such a long period of compounding. This is a regular feature of fund industry experience. A fund that puts together a strong track record in its early years is then heavily marketed but is unable to repeat the performance for the new wave of money that flows into the fund. Nevertheless, the returns from compounding remain significant over shorter periods as well. Investors in the Templeton Growth Fund on average doubled their money every 5 years in nominal terms. One reason is that, contrary to normal fund management experience, the margin by which the fund outperformed the market as a whole increased rather than fell once the fund began to grow in the 1970s. From its inception until the end of the 1960s, while the fund grew 9-fold, as we have previously noted, according to our figures, it did little more than keep pace with the world stock market over that period. We use a proxy for the MSCI World Index, as no global market index existed at that time, reflecting the lack of cross-border portfolio investment during this period and the fact that just 2 stock markets, the United States and the United Kingdom, dominated the world in terms of market capitalization. Between 1969 and 1992, the years when John Templeton lived and worked in the Bahamas rather than on Wall Street, the margin by which the fund outperformed the world index increased dramatically, averaging an even more remarkable 6.0% per annum. Thanks to compounding, this generated further substantial capital gains for the fund's investors. The compounding of returns is one of the strongest reasons for considering a disciplined, long-term investment strategy of the kind John Templeton first pioneered and then practiced himself. Consistent real returns. Another notable and possibly unique feature of the Templeton Growth Fund's performance under John Templeton is the 100% consistency with which it achieved positive 5-year returns, not just before but also after allowing for inflation. From year to year, the fund inevitably experienced significant volatility. Like all investors, John Templeton had good years and bad years. The fund achieved its best 12-month return in the year to November 1972, gaining 80.7%, and suffered its worst 12-month decline in October 1974, declining 25.0%. Measured in calendar years, the fund produced a negative return in 10 out of the 38 years during which John Templeton was in charge. However, Templeton himself never claimed to be able to beat the market in every single year, and always emphasized the importance of investors investing for the longer term. His own holding period for an investment was typically 4 to 5 years. 5 years was also the period over which he urged investors to judge the performance of his fund. The performance of the fund in real terms over 5-year periods perhaps demonstrates more clearly than any other figure why Templeton was to achieve such renown as a professional investor. There was not a single 60-month period in the 38 years during which the Templeton Growth Fund failed to produce a positive return, not just in nominal terms, but also after taking account of inflation. The worst 5-year real return of the fund was 8.6%, or 1.7% per annum, in the 60 months up to and including July 1982. By contrast, over the same 38-year period, the MSCI World Index failed to produce a real 5-year return on several occasions. And in its worst 5-year period, the 5 years to September 1974, lost a third of its value, 33.8%, in real terms. Even T-bills, or short-term treasuries, which are widely regarded as the safest form of U.S. government bond, produced negative returns in some 60-month periods at this time. Yet any investor who bought the Templeton Growth Fund and had the patience to hold onto it for 5 years would have been certain of seeing his or her money grow in value even after allowing for the effects of inflation. Not that this always satisfied those investors or the media. A good deal of focus on fund performance, then as now, was much more short-term. On more than one occasion, despite his growing reputation, Templeton was criticized for the poor relative performance of his fund. In the 5-year period from 1971 to 1975 inclusive, for example, he underperformed the market in 3 out of 5 years. He did the same again in the mid-1980s. Investors who had money in the fund at these points might have begun to wonder whether he had lost his magic touch. Forbes magazine, which had earlier highlighted Templeton's success in glowing terms and was one of his most fervent supporters, at one point published a cover article questioning whether the great John Templeton had lost his way. "Has the king fallen off the mountain?" it asked. Hindsight tells us, however, that this was exactly the moment to have put money back into the fund, as the fund subsequently produced one of its best periods of performance. Evidence of the old saying that, in investment, just as in sport, form may be temporary, but class is permanent. Less, not more, risk. Most of the time in investment, higher returns imply higher risk. This was emphatically not the case with the Templeton Growth Fund. Not only did the fund consistently produce higher returns than the MSCI World Index, it did so with less rather than more risk than the stock market as a whole, as standard finance theory would suggest should have been the case. Explaining why this was so shows up some of the dangers in applying simplistic statistical tests to fund performance data. The standard way in which fund analysts compare the risk of competing funds is by comparing the volatility, or standard deviation from the mean, of their monthly returns. On this measure, taken in isolation, there is little difference between the performance of the Templeton Growth Fund and the MSCI World Index. Over the period 1954 to 1992, the standard deviation of the fund's monthly returns was in fact slightly higher, at 2.94%, than that of the World Index, 2.70%. The same was true with its 12-month returns. On this narrow measure, therefore, while the fund clearly produced more return per unit of risk, it could not be described as being less risky. The problem, however, as finance theorists themselves now concede, is that volatility is far from a perfect measure of the risk that faces investors. Citing a standard deviation figure gives an indication of how variable the returns from a fund have been, but it cannot distinguish whether the divergence of those returns from the average has been mainly positive or mainly negative. In statistical terms, we can say that it relies on the assumption that a fund's returns follow a normal bell curve distribution, with an equal number of observations on either side of the average. While that is roughly, though not precisely, true of the World Stock Market Index, it is certainly not an accurate description of how the Templeton Growth Fund performed. John Templeton's genius as a professional investor was to discover and then put into practice an investment approach which ensured that his fund produced significantly more above-average returns than it did below-average returns. This had the important consequence of reducing the likelihood that the fund's investors would experience losses. The simplest way to see this is to compare the distribution of average monthly returns from the fund with that of the World Index over the 38-year period. Plotted as a histogram, it would clearly show 1. How the fund's returns were more narrowly bunched around their long-term average than those of the World Index, and 2. How the number of above-average returns was disproportionately greater than the number of below-average returns. The corollary to this is that there were also periods when the Templeton Growth Fund failed to keep pace with the rising world market. So, for example, the best 5-year real return that the fund achieved was a gain of 205% in the 60 months ending in August 1986. During this period, one of the strongest 5-year periods of all time in stock market history, the MSCI World Index rose by an even more remarkable 286%. As we have seen, there are good reasons why the fund tended to outperform during the strongest bull markets, just as there are good reasons for its consistently above-average performance during bear markets. As already noted, the Templeton Growth Fund was prevented by the terms of its mandate from using debt to leverage its returns. While the use of debt increases the potential scope of returns, it also significantly increases the risk of significant loss for investors. John Templeton himself retained a lifelong aversion to the use of debt for investment purposes and counseled most investors against borrowing for the purposes of stock market speculation. If he had been able to use leverage, the fund's returns would have been even higher over time, but so too would have been its losses in the down periods that it did experience from time to time. The most important point to emphasize, though, is that the periods when the TGF underperformed the market were generally those when the fund was already itself making very good positive returns. The periods when it outperformed the market were typically those when the market was suffering much greater losses. It was this bias against absolute losses, the fact that the fund never lost money over any 60-month period, which is the truly distinguishing feature of John Templeton's record as a fund manager. This track record can be traced directly to the valuation and stock selection discipline on which Templeton insisted at all times. His mantra, "Only buy cheap stocks," may have cost his fund some performance in bull markets, but it more than earned its keep during bear markets. Bull and bear markets. As most investors know, the stock market moves through distinct phases when share prices are generally either rising, a bull market, or falling, a bear market. When looking at the main bull and bear markets that occurred during the period in which John Templeton was responsible for managing the fund, and comparing the movement of the world stock market index with that of the performance of the Templeton Growth Fund, some interesting conclusions quickly become apparent. Almost all the Templeton Growth Fund's outperformance, our analysis shows, came during bear markets. When stock markets started what proved to be a substantial decline, the fund either fell less sharply or continued to produce positive returns. On average during bear markets, the fund lost money, but on a much less dramatic scale than the market as a whole, minus 12% against minus 21%. This is an important and significant difference. A fund that has fallen by 20% has to recover by 25% to regain its former level. One that has lost 12% needs to recover by 14% to do the same. Bear markets, in other words, unless anticipated, can be serious destroyers of wealth. At all other times, however, while the fund still outperformed the market over 5-year periods, the difference was slight. In fact, we can establish no statistically significant degree of under- or overperformance relative to the world stock market index during bull markets. What is clear, however, is that during the strongest bull markets, and especially during periods of market euphoria, there was an observable tendency for the Templeton Growth Fund to underperform. This feature is characteristic of investors who follow a value approach, as is discussed further in Chapter 5. The Templeton Fund's record supports his contention that the biggest risk investors face is overpaying for what they own. Performance trends over time. For the first 10 years of its life, while its performance was good, the fund, in fact, failed to outperform the MSCI World Index or its equivalent. Templeton himself noted that his performance improved substantially when he left New York in the late 1960s in order to set up home at Lyford Key in the Bahamas, then a British colony. The data confirms that this was indeed the case. The years between 1969 and 1992 produced better returns for the fund than before or afterward. An analysis of the data will show that it is evident how badly the fund underperformed in the world market index in the second half of the 1980s. This was the period during which Templeton reduced his significant holdings in Japanese stocks and increased his holdings in the United States, which he believed, and said publicly, was poised for a multi-year bull market. He was right, but his timing for this move proved to be way too early, as the Japanese market continued to rise strongly until it peaked at the end of 1989, several years after Templeton had reduced his holdings in Japan to a minimal level. One consequence of this was that the Japanese stock market's share by value of the world index remained at more than 40% throughout this period, making it virtually impossible for any professional investor without a large holding in Japanese equities to beat the index. The stocks that Templeton was buying in the United States were materially cheaper than their equivalents in the Japanese market and indeed performed very strongly. Japanese shares continued to power ahead even faster, however, taking the Tokyo market to an all-time peak in 1989. An absurdly inflated level from which it has still, more than 20 years later, to recover. During the second half of the 1980s, the Japanese stock market was trading on a P/E ratio of more than 60, which was at least 4 times the equivalent rating for the U.S. stock market. At the worst point, the Templeton Growth Fund was lagging the world index by more than 100% over 5 years. Investors in the fund were, however, still receiving good portfolio returns. It was just that the world index, inflated by the Japanese bubble, was doing even better. When the bubble burst, Templeton's investors had good reason to be grateful for their manager's conservatism. At the time, though, many were not slow to complain. To sum up, therefore, we can clearly see that the performance of the fund was indeed exceptional. The risk of losing money in either nominal or real terms for any investor prepared to hold the fund for 5 years was, in practice, non-existent. More notable still was that it improved rather than deteriorated over time, and for many years under Templeton's personal stewardship, proved immune to the normal phenomenon in the fund world that popularity is inimical to continued good performance. Closer analysis shows that almost all its outperformance came during bear markets, when its losses were smaller than those of the market as a whole. This in turn reflected the fact that Templeton's understanding of what constitutes risk in investment was deeper and more profound than that encapsulated in the analytical tools widely adopted in modern investment practice. Chapter 4. Philosophy in Action. The philosophy that Sir John Templeton developed and refined over the course of his long investment career was faithfully reflected in the way that he managed money, both his own and that of others, whether they were clients of his investment counsel firm or investors in his funds. The essence of that approach was to act on logic rather than emotion, to rely on quantitative rather than subjective analysis, to think for himself and ignore what other investors were saying and doing, and to approach the business of investment in a systematic way that reflected his own deep understanding of how the financial markets actually work. His greatest advantage as a professional investor was that his investment philosophy was both thorough and consistent, and entirely attuned to his own knowledge, personality, and temperament. The qualities that any investor with an investment philosophy such as Templeton's requires, the ability to be patient, calm, dispassionate, bold, were all ones that he possessed to a marked degree. Sir John, says fund manager Ken Fisher, had ice in his veins, and really lived the idea, don't follow the herd. To help popularize his approach, throughout his life John Templeton sought to capture the essence of his approach in a series of maxims about the requirements for investment success. Phrases such as, "The best time to invest is at the point of maximum pessimism," and "This time it's different," the 4 most dangerous words in investment, have passed into common usage in the profession. In this chapter, we use these maxims as a framework for discussing how his philosophy can be implemented in practice, recognizing at the outset that this is no easy task and that there are important differences in their relevance to private and institutional investors, just as the way in which Templeton advised clients to invest was different in some ways than the way he managed a fund. The version of the maxims we have chosen to use is the one that was published in World Monitor, the Christian Science Monitor Monthly, in February 1993, under the title 16 Rules for Investment Success. There are several other versions in existence, however, some with a different number of rules or differences in wording. The version referred to here can be usefully compared to the version published in the first full-length biography of John Templeton. These maxims are reproduced in the appendix. Between them, these 2 lists capture all the most important elements of his investment philosophy. For the sake of convenience, we refer to the first list as his rules and the second as his maxims. An important paradox. It is worth emphasizing at the outset, however, that there is an interesting and rarely appreciated paradox in the way that John Templeton approached the business of investment. The paradox is that while the process he adopted was austere in its rigor and firmly quantitative in its application, his philosophy was rooted less in dry analytical analysis of what works in financial markets than in his understanding of human psychology and behavior. The latter, he believed, was the primary factor that underpins the behavior of security prices and created the bargains for which he spent his life looking. His insights into the human condition were not just central to his moral and religious beliefs, but helped to explain why he was always so extraordinarily confident that his methods were the right ones and would, if properly applied, result in superior, lower-risk investment performance. Sir John's religious and ethical beliefs cannot therefore be seen in isolation from his career as an investor. The reality is that he did not have two sets of fundamental principles, one for life and one for investment. One set of principles underpinned everything that he did. In an important speech entitled "The Religious Foundation of Liberty and Enterprise," which he gave at Buena Vista in 1993, shortly after he had sold his fund management business, he outlined what those principles were. Although the focus of this book is primarily on his investment philosophy, the speech is an important source for those seeking to understand the roots of his market philosophy. The speech lists what he described as the main virtues and vices to which humankind is prone. From these he derived a number of timeless practical issues that are relevant to any investor in any period. The vice of envy, for example, which he defined as joy at the suffering or misfortune of others, is often reflected in society by penal tax rates and the expropriation of private property. One of the rules by which Templeton lived was to avoid investing in countries where governments either imposed high tax rates or failed to respect private property rights. The latter can be reflected in outright expropriation, or in less obvious ways, such as failure to enforce copyright protection and intellectual property rights. Similarly, because of greed, another widespread vice, the modern form of capitalism, Templeton noted, is often too hedonistic and unethical, and too far removed from traditional virtues. This economic vice is a source of many crimes, public and private. It can also turn up in bad personal habits, like accumulating too much debt, or going on buying sprees to improve self-image. After a decade that saw the collapse through fraud of Enron and Global Crossing, and a full-blown banking crisis induced by banking behavior that was shamefully driven by financial self-interest, the relevance of this observation need hardly be doubted. The abuse of stock options, introduced originally in an effort to align the interests of shareholders and management, but which have since been gradually transformed into a mechanism by which senior managements could enrich themselves at shareholders' expense with minimal risk, is another prime modern example. After listing examples of pride and intolerance, Templeton also focused on the flaws in moral relativism, the notion that there are no absolute rights and wrongs, only degrees of wrongdoing. In his view, economic utilitarianism, a doctrine to which many elected politicians are vulnerable, is a version of moral relativism because it pretends that profit and loss can substitute for right and wrong. This view was behind Templeton's unwillingness to invest in certain industries on moral grounds, including tobacco, alcohol, gambling, and pornography. When questioned about this policy in public, he tended to be circumspect, saying only that while he respected differences of opinion, he would follow what his conscience dictated. He did not ban his employees from smoking, But there was no doubt that he believed it was wrong of investors to encourage such human activity through buying the shares of companies that catered to those needs. Turning to what he called the economic virtues, one that stands out is his call for greater integrity in both business and governments, an idea he summarized as, pay your debts, don't cheat your neighbor, don't use false weights and measures, keep your financial commitments. Long before the current global sovereign debt crisis, he was urging the virtue of integrity on elected governments. We have gotten used to the governments that run high deficits. Every day we hear about politicians that do not tell the truth about the state of the nation's finances. Inflating the currency away through unsound political practices is a form of changing weights and measures. He went on, nothing can kill economic liberty like a widespread lack of personal integrity. Over time, people stop trusting others. When you cannot trust your neighbor, you cannot trade with him. Enterprise comes to a halt. There has been no better example than the global credit crisis of what can happen when lenders and investment banks, for example, put short-term profit above their duty to care for their clients. It is for this reason that Templeton always favored countries such as Japan and Korea, in which business success is admired and society favors hard work and personal responsibility. Financial markets, in turn, reflect the consequences of these shortcomings in personal behavior. Share prices, it is a simple matter to observe, are considerably more volatile than can be justified by changes in the economic fortunes of the companies that issue them. In an average year, the U.S. stock market historically has risen by around 10% per annum. Yet the average daily movement in the leading stock market indexes is around 0.8%. Given 240 trading days a year, that adds up to 192% a year of aggregate share price movements, or 19 times the average annual change in market values. The drivers of share prices in the short term, as is often said, are fear and greed. Those human faults, combined with institutional pressures, are ultimately what make the Templeton investment philosophy work. By driving share prices away from levels that are justified in economic terms, they create the opportunities from which dispassionate bargain-hunting investors can profit. Investing by the rules. The 16 rules laid down by Templeton are models of clarity and simplicity, and indeed, in many respects, simply statements of common sense. An interesting question to keep in mind, as already noted in the previous chapter, is why they appear to be so difficult in practice for many investors to implement. The most obvious explanations appear to lie, first, in the shortcomings of human nature, and second, in the extraordinary capacity of the modern institutional investment industry to encourage behavior that is antithetical to longer-term investment success. John Templeton's set of beliefs about investment rested on the presumption that it requires considerable courage, confidence, and commitment to avoid being dragged into following the herd or the crowd. Yet it is no exaggeration to say that all the pressures that now affect professional investment managers and advisors combine to push them toward just such an undesirable outcome. Invest for maximum real total return. Rule 1. In whatever form Sir John's investment rules or maxims were published, invest for maximum real total return was always the first and most important. It makes the simple point that the only true measure of an investment's performance is how much each dollar or pound invested produces by way of a return after taking account of all relevant deductions. The three most important deductions most investors face are 1. Taxation, 2. The change in the purchasing power of the currency they have used to make the initial investment, and 3. The cost of implementing an investment strategy, such as trading costs, professional fees, or, in the case of managed funds, annual management charges. A simple example can explain the force of this maxim. Imagine two investments, A and B. Investment A, which is held in a taxable account, pays an annual income equivalent to 6% of the purchase price and generates capital growth at the rate of 20% per annum. Investment B is held in a tax-free account, but only pays an annual income of 4% per annum and grows in capital value at only half the rate of investment A, 10% per annum. Inflation is running at a constant rate of 5% per annum, and both investments are held for a period of 5 years. It is clear that investment B is in fact a better proposition than A, even though the headline rates of return from the latter are higher. Because of inflation, the other point to note is that the real purchasing power value of both investments is notably less than the headline figures at the end of the 5-year period. After 5 years, inflation of 5% per annum has the effect of reducing the value of money by more than a third. The emphasis on total return is important. Total return comprises the returns from a rising share price together with the dividends paid to the investor. Contrary to what many investors appear to think, given their fixation with short-term share price movements, historically the dividend flow has been the most important factor in generating long-term returns. A company pays increasing dividends in the long run only if it can increase its profits. The value of a business is defined by the future profit stream, part of which is returned in the form of dividends and part of which is retained to finance future growth. The real after-tax total return that an investor receives, therefore, depends simply on how much he or she must pay to participate in the future stream of profits, whatever they may turn out to be, and in whatever combination of dividend and capital appreciation they happen to materialize. Pay a low price relative to valuation and the results are likely to be above average. Pay too much and the total return will tend to be poor. Investors can pay too much for a range of reasons, but the obvious ones are 1. Overestimating the future rate of growth, and 2. Correctly estimating the rate of future growth, but paying too much for it. It is worth emphasizing that the study of the relationship between earnings and share prices described in the next chapter, which we use to explain why the Templeton method works, takes account of both inflation and corporate taxes. Invest. Don't trade or speculate. Rule 2. Templeton's second rule, invest, don't trade or speculate, epitomized his approach. There are two types of investors who trade and or speculate. The first type are those who do so deliberately or for professional reasons. Day traders would be one example, proprietary traders at large investment banks and hedge funds another. The second type are those who do not realize that speculating is in fact what they are doing. In other words, they are investors who focus on picking stocks that they think are going to go up in price without having a sound analytical reason for expecting that result. Speculation has its place in the financial system as a source of liquidity and what economists like to call price discovery, but it is a hazardous and, in Templeton's view, foolish way to go about making money in the longer term. If, as the earnings study shows, short-term movements in share prices are effectively random, it follows that if you are investing on the basis of short-term financial results, then by definition you must be speculating in the formal sense of the word. Templeton's conviction, based on many years of experience, was that seeking to make money by predicting short-term price movements was unlikely to produce consistently good results. Speculation, in his view, was little better than gambling, pointless when there was a more scientific way to approach the business of investing, and foolish given that the evidence that it works is so thin. Many investors, it is fair to say, believe the exact opposite. They assume, whether implicitly or explicitly, that far from being random, short-term movements in stock prices are predictable, and that they can exploit that predictability. Many investors think that the stock market exhibits what statisticians term autocorrelation. This means the fact that a stock that has risen in price is more likely than not to continue to move in the same upward direction. The same is true for stocks whose prices have declined. Having started to fall, the presumption is that they are more likely to continue in that direction than move upward. A professional term for this phenomenon is investing in momentum. Recent studies have shown that there is some evidence that momentum strategies do produce consistent returns over some time periods. A number of hedge funds have sought to exploit this fact, some employing highly sophisticated mathematical formulas to try and capture profit from this effect. It is fair to say, however, that the results have been far from convincing. Using momentum, buying recent winners and selling recent losers, is far from being a surefire way to make money. On the contrary, the costs of implementing such a strategy can be high, particularly for private investors. And while the strategy can be profitable for some time, it has the nasty habit of producing out of the blue sudden sharp losses that are capable of wiping out most, if not all, of the previous gains for investors. Speculation is dangerous not just because the outcome is unpredictable, but because it does not rest on any logical fundamentals, and it ignores the most important fundamental of all, which is valuation. Any investor who has no concern for valuation is effectively subscribing to the greater fool theory, the idea that there will always be somebody more foolish to buy your expensive stocks at an even higher price at a later stage. This is pretty close to a definition of gambling. The banking crisis of 2007 and 2008 showed that this pattern of behavior can extend to supposedly professional stewards of money. Banks and insurance companies such as AIG fell over themselves to insure enormous amounts of risk in return for very small premiums, while booking those premiums as profits. When the credit bubble burst, it wiped out all the accumulated profits on the transactions and created huge losses on top of that as well. The Internet bubble of 1999 to 2000 was another classic example where investors became transfixed by the way stocks of Internet companies kept on rising, despite never having made a profit, or in most cases, having any appreciable prospect of doing so. The information technology revolution has encouraged the trend toward increased trading and speculation. The turnover of stocks on the main trading exchanges of the world has risen sharply over the last 2 decades. Computer-generated trading systems now account for nearly 3/4 of equity trading volume in the United States, according to an official UK government report. The number of instruments that can be traded, notably derivatives, has also grown exponentially. The average holding period of stocks on the New York Stock Exchange has fallen from 8 years in the 1950s to less than 6 months today. Advances in information technology mean that almost every day produces a new device or medium that allows yet more information to be delivered in real time. The financial world, it seems, has set a course that militates against the kind of patient, long-term investment that John Templeton advocated and practiced. Remain flexible. Rule 3. Over the years, John Templeton was given many flattering titles by the media. One of these was Dean of Value Investing. However, this kind of accolade is misleading, to the extent that it implied he was following a rigid set of specific investment criteria. Value investors, in the traditional sense, insist on limiting their stock purchases to stocks that meet certain specified criteria, such as a minimum return on assets, a maximum price-earnings ratio, or a minimum level of dividend yield. Templeton's approach could not have been more different. Within a sensible logical framework, he was willing to consider any method that might help to identify what he preferred to call bargains. In his analysis of individual stocks, he recognized that there were various combinations of value and growth that could produce a company that was cheap on a 5-year forward earnings view, It could be a slow-growing, dividend-paying company whose shares were simply too low, or it could be a fast-growing company whose shares did not yet fully reflect that rate of future growth. Never adopt permanently any type of asset or any selection method was one of his maxims. Market conditions also change, and investors need to stay flexible, open-minded, and skeptical. This did not simply apply to equities. For him, all asset classes were potential investments. What mattered was whether they were cheap by reference to their intrinsic value. He was never solely wedded to investing in one asset class only. The same flexibility applied to the methods he employed for identifying and evaluating individual companies. Any restriction or bias, in his view, was liable to reduce an investor's potential returns. A good example of this flexibility came in the spring of 2000 when Templeton, one of the greatest stock pickers of all time, advised readers of a financial magazine to switch their focus from equities to treasuries, U.S. government bonds. For his own account and that of his foundations, he personally invested more than $100 million in a leveraged bet on long-dated zero-coupon U.S. Treasury stock, funded by cheap borrowing in yen. He reinforced this position by taking a very large short position on technology stocks, which had become massively overvalued during the Internet bubble. Both positions produced handsome rewards. Shorting the technology stocks made a profit of $90 million, and the treasuries produced a gain of more than 80% over the subsequent 3 years. Anyone who came into contact with Sir John would immediately realize his openness to new ideas. Many professional investors react angrily to the suggestion that there is a better investment method than the one they have chosen to be their own. Sir John, in our direct experience, was the exact opposite. For him, investment was a never-ending search for more and better ways of investing. He was willing to consider any potential method of identifying investment opportunities, however harebrained they might seem at first sight. A former colleague of one of the authors recalls walking into Sir John's office to find him looking up at the sky, using a comb to guide his line of sight. The colleague knew at once that this had to be another one of what the office openly nicknamed Sir John's crazy ideas. Sure enough, lying on his desk was an open book about sunspots and their impact on stock markets. Most professional investors would be incredulous that sunspots could be taken seriously as a guide to the behavior of stock markets, yet Templeton was doing just that. He was genuinely interested in whether a relationship between the incidence of sunspots and stock market movements could be shown to exist. If there was, that did not mean that he thought that there was necessarily a causal relationship between the two. It might be that the incidence of sunspots reflected some more subtle, indirect effect, for example through their impact on the weather in crop-producing areas. That, in turn, could be an important piece of information when considering the price of agricultural equipment manufacturers. The point is that he was willing to explore the subject without dismissing it out of hand. He was always asking his colleagues to search for explanations for apparently bizarre phenomena. For his colleagues, such intellectual humility and openness to new ideas was striking, given how experienced and successful he had become as an investor. He also had a voracious appetite for new ways of identifying potentially cheap stocks. Colleagues lost count of the number of new stock screening ideas that he dreamed up or encouraged. For example, he had a view that pharmaceutical companies spent too much on research and development. One screen his funds followed as a result was based on adding back half of their R&D expense to see what difference that might make to their valuation. Similarly, while a 5-year forecasting period was the one he instructed his analysts to use, for reasons, as we have seen, which turned out to be very sound, He was also interested in making even longer-term forecasts and using that as the basis for picking a small number of additional stocks that failed to qualify under the standard analysis. These stocks he termed Q stocks. To qualify, a company had to be able to show earnings quadrupling over a 10-year period, which is equivalent to growing at a compound rate of 15% per annum. Such openness to new ideas is often regarded as anathema in professional investment firms, where process has a tendency to take over from principles in investment analysis. Rules, hurdle rates, and checklists tend to proliferate. The larger the investment company, the more restrictive and rule-bound the process tends to become. Templeton's investment philosophy was that value was based on the ultimate earnings power of a company and manifested itself in the long-term after-tax profits a company could generate. Any number of analytical techniques can help in this search. Dogged adherence to just one technique, or one set of ratios, is unlikely to produce the best investment results. Yet this is the direction in which process tends to drive most professional investment firms. If investment analysis were easy, we would not need to rely on emotional human beings. Instead, we could simply build models to make decisions and then be ruled by a predetermined investment process. A number of so-called quant firms have been set up to do just that in recent years. They employ sophisticated computerized algorithms to make trading decisions. The difficulty is that the world does not repeat itself exactly, and hence such trading strategies are vulnerable to sudden, unexpected blow-ups when the world ceases to behave in the way that it did. The collapse of long-term capital management in 1998 provides a notable example. The firm counted 2 Nobel Prize winners in economics and several stars from Wall Street among its employees. Its investment strategy was designed to exploit small pricing anomalies identified by sophisticated computer models. Yet the historical relationships from which those anomalies derived collapsed overnight during a market panic triggered by the threat of an unforeseen event, a debt crisis in Russia. The problems that afflicted many quant funds in 2007, when the banking crisis started to unfold, provide another example. Buy low. Rule 4. This is the exact opposite of momentum investing. Momentum investing invites investors to buy high and sell higher. Buy the most popular stocks that everyone else is buying and stay for the ride. In contrast, Sir John's most famous saying was that the best time to buy is at the point of maximum pessimism. This does not mean simply to buy anything where the share price is falling. What he was saying was that security prices are discounting mechanisms, and if you can ascertain the value, then you should buy when the share price is out of line. By definition, this was most likely to happen when sentiment was unduly negative, and that would therefore prove to be the point at which the best results could be obtained. To illustrate this point, Templeton often liked to compare the investment industry with other professions. His reasoning went like this. If 10 civil engineers tell you to build a bridge a particular way, then that is how you should build the bridge. If 10 doctors provide the same diagnosis, then you should follow their recommended treatment. However, if 10 investment advisors tell you that a particular stock is cheap, then the last thing you should do is invest in it. He did not mean to imply that any of the 10 investment advisors were lacking in intelligence or their dedication to ethics. It was simply an illustration that the market is a discounting tool, and if everyone thinks something has good prospects, then in all likelihood the share price will already have reacted and will no longer be cheap. It is impossible to produce a superior performance, runs the third of his maxims, unless you do something different from the majority. Out of this comes the idea of contrarian investing, or being different from the crowd. In our experience, the concept of contrarian investing, as John Templeton understood it, is frequently misunderstood. For some, it is taken as implying that investment should be conducted by figuring out what everyone else is doing and then doing the opposite. All sorts of tools, from sentiment surveys to monitoring investment flows, are available for those who are looking for information of this sort. Such indicators have their place. The main difficulty with adopting this approach is that it pays no attention to valuations. There are many occasions when the consensus will be right, not wrong. It is only when sentiment is adverse and valuations are low that being contrarian will pay off as handsomely as Templeton suggests. The more logical process, in Templeton's view, is to start with valuation and then move to portfolio construction. To the extent that the cheapest stocks are out of favor, then the portfolio this produces will look very different from whatever is in vogue with investment markets. It can therefore be safely described as contrarian. The key point, however, is that this is the outcome of a process driven by valuations rather than contrarianism being itself the process. Since the search is for the companies with the greatest difference between their long-term value and their current share price, it is logical to expect portfolios to have a contrarian look and feel. However, the buy low rule does not mean buying shares just because they are low. Many shares fall for good reasons. Search for quality among bargain stocks. Rule 5. Central to John Templeton's investment philosophy was that when investing in companies, the sustainability of earnings was of critical importance. Since you were buying a long-term stream of earnings, the solvency and sustainability of those earnings are essential prerequisites. For example, it was unwise, in his view, to invest in businesses where the balance sheet was so weak that it was open to question whether the company would survive. Given the choice, his reasoning went, a quality stock should always outrank lesser companies as a potential investment. As we have already noted, this was advice that he himself had deliberately ignored at an early stage of his career, with his speculative but ultimately successful foray into the stock market at the outbreak of World War II. What makes a quality company? Some of the characteristics he looked for were a strong management team with a proven track record, evidence of technological leadership, an industry with continued growth potential, a respected and valuable brand, and low-cost production. In essence, he was looking for companies that enjoyed a sustainable competitive advantage within a supportive environment. While an investor is unlikely to find all these characteristics in one company, there should be at least a number of identifiable sources of competitive superiority, just as you look for 3 or 4 stars in a restaurant. The problem with buying quality stocks is that their quality characteristics tend to be obvious to all investors. As such, their superior qualities are already likely to be reflected in their share price. It follows that the most likely time investors have an opportunity to buy quality stocks at bargain prices is when the whole stock market has become infected by fear and share prices are falling in an indiscriminate manner. For most of the rest of the time, when deciding whether to buy a quality stock, the investor is faced with deciding whether the price at which it is available is sufficiently attractive to justify paying for the quality on offer. It is a trade-off between risk and reward. Quality stocks generally carry much less risk in terms of their future profit profile, and hence their valuations are not subject to so much uncertainty. So long as the valuation is reasonable, they are then the preferred investment. Stocks where there is greater doubt over future earnings are higher risk and would count as bargains only if the potential reward is commensurate with the risk being taken and can be included in a diversified portfolio. Quality stocks are not without risk to shareholders, even if they have a predictable profits stream. Pay too much for them, and investors are still at risk of losing money. Buy value, not market trends. Rule 6. Another key component in Templeton's investment approach is that a stock market is simply the aggregation of the underlying companies. It is not an entity in its own right. Furthermore, he argued, The market and the economy do not always march in lockstep. Bear markets do not always coincide with recessions. His conclusion, therefore, is buy individual stocks, not the market trend or economic outlook. Any investor with more than a few years' experience will have learned the wisdom of this observation. The well-known saying that bull markets have to climb a wall of worry is just one example of how share prices often seem to be moving in the opposite direction to that which the news seems to justify. Witness also the often bitter complaints from company executives that their share price is failing to reflect their most recent results. Templeton from an early stage was also dismissive of economists' ability to make useful forecasts, something that he used to justify his non-forecasting method of asset allocation for clients of his firm. In all these cases, the underlying explanation is the same. When you invest in a company, you are buying a potential long-term stream of earnings. Few, if any, companies, though, have earnings that grow in a straight line. Revenues, margins, and profits vary with the economic cycle irrespective of their underlying or long-term rate of growth. Simply extrapolating recent results may, as a consequence, often make a company look incorrectly expensive or cheap. A recent discussion with the company Applied Materials provides a good example of this phenomenon. Applied Materials is a company that would satisfy almost all of John Templeton's quality criteria. It supplies manufacturing equipment for producers of advanced semiconductors, flat panel displays, and solar photovoltaic products. It has a rock-solid balance sheet, strong management, technological leadership, and a product portfolio in industry segments that are experiencing steady growth. But its earnings are also cyclical because its customers delay or defer orders when semiconductor demand falls. The company's profit margins fall when demand falls, and rise when demand recovers. But given the rapid nature of change in the IT business, these delays tend to be short-lived. As a result, over very short periods, for example 9 months, since orders are already in production, it is relatively easy to predict future earnings. Given the company's competitive advantages, the same goes for the long term. However, for periods between 9 months and 5 years, earnings are virtually impossible to predict, given the volatility of orders arising from customers' delayed or deferred decisions. Simply extrapolating recent results is therefore almost certain to produce the wrong result. For the modern investor, the difficulty of identifying long-term value in stocks is compounded by the widespread availability of information that appears relevant, but in practice distracts from the main objective. Surprisingly little of the information that proliferates across Bloomberg screens and Internet sites relates to whether a stock is cheap or not. Wonderful products, increasing market share, telegenic and charismatic CEOs, new and exciting markets, all these are interesting pieces of information, but most of them are tangential to the central issue of whether a stock qualifies as a bargain. Even the most experienced professional investors struggle to say whether a stock is cheap. What you hear, as often as not, is not a statement about absolute or intrinsic value. It is a statement about relative value. Think for a moment about the following commonly heard statements. The company is going to come in ahead of earnings expectations, and therefore it is cheap. The company trades at a meaningful discount to others in its sector, and therefore it is cheap. The company is trading at a discount to historic valuations, and therefore it is cheap. If you value the other divisions of this company like their competitors, then you get this division for free, and therefore it is cheap. The company has major growth opportunities in the most exciting growth areas in the world, and therefore it is cheap. The company has the best, most visionary CEO in the business, the man who almost single-handedly built the industry, and therefore it is cheap. The company has the leading brands in all its sectors, and therefore it is cheap. The company was the first into this technology and has clear intellectual leadership, and therefore it is cheap. Every one of these statements contains a comment that may or may not be true, followed by the same non sequitur. The simplest explanation for the myopia of investors lies in the complex matrix of intelligence and emotion that shapes human behavior. Detachment is difficult, and the power of conventional wisdom makes it difficult to deviate from it for any sustained length of time. John Maynard Keynes famously said of professional investment, "Worldly wisdom teaches that it is better for reputations to fail conventionally than succeed unconventionally." In addition, there is the phenomenon known as business risk to consider. For many professional investors, fear of being fired is a dominant concern in determining how they behave. Experience shows that investment managers are more likely to be fired if they deviate significantly from what other professional investors are doing. In the interests of self-preservation, the path of least resistance is to continue behaving like the majority of other investors. It is the source of such common refrains as these: "It does not matter if I am right. By the time it comes true, I will have no clients." Or, "My competitors own all these stocks, and if I do not, I will be left behind. I have, however, taken a prudent position of being underweight." And one of our personal favorites: "These stocks may look expensive, but they always trade at these valuations." In essence, they are all saying the same thing. It is, "Although I know these stocks are expensive and hence will ultimately lose money, it suits me to do something that will hurt clients because, in the short run, it will be better for me." It is certainly the case that the pressure on underperforming fund managers can be intense. However, fund managers are very well paid and enjoy a career that is virtually free of physical danger. It is human nature not to take heed of Templeton's view that investing other people's money is a sacred trust. A professional investor who believes that a stock is expensive should not own that stock, period. All other justifications are self-serving. This does not mean that investors who follow Templeton's investment principles will not end up owning stocks that turn out to be expensive, rather than bargains. As we have seen, Templeton himself thought that anyone who gets 6 out of 10 investment decisions right was well on the way to beating the market. In analyzing future earnings, mistakes are inevitable, however good the analyst. Forecasting the future is difficult, and you cannot get anything correct without accepting that you will also get some things wrong. Knowingly buying an expensive security in order to protect a personal career stands in quite a different light to making an honest mistake in analysis. Professional investing, to reiterate Templeton's view, is ultimately a matter of personal morality and integrity. Diversify your holdings. Rule 7. John Templeton had distinctive views on the importance of diversification. To any potential investor, he extolled the benefits of spreading portfolios across a range of different types of investments. The obvious common-sense reasons include the risk of unexpected external events and the fact that different types of investments react differently to changes in the economic and political environments. Investing across a number of different countries is clearly a defense against something bad happening in any one of those countries, and similarly for individual stocks. He had no specific rules about how many stocks were needed to achieve the necessary amount of diversification. We have seen how the Templeton Growth Fund's portfolio was much less diversified in its early days than later when it had become so much bigger in size. However, for him, the greatest risk against which diversification guarded was that the analysis preceding an investment might simply be wrong. In his words, "The only investors who shouldn't diversify are those who are right 100% of the time." In practice, no such paragons exist. By the same token, the less confident an investor is in his or her methods, the more diversification is justified. There could never be a justification, however, in his view, in buying overvalued stocks purely because they had different characteristics or were components in an index. That kind of diversification for its own sake, or index hugging, made no sense to him. Do your homework. Rule 8. Sadly, investment is hard work. It is not based on gut feel or intuition. John Templeton subscribed to the golfer Gary Player's maxim, "The harder you work, the luckier you get." One of his own maxims was, "Achieving a good record takes much study and work, and is a lot harder than most people think." In investing in a company, you are buying a future profits stream or the assets to produce one. There are no shortcuts to obtaining this information. Company analysis is relatively straightforward in a technical sense. Almost anyone can learn to read a set of financial statements and interpret what is contained within them. It is much harder to try to figure out how an industry may evolve in the future and how a particular company will adapt to that changing environment. However, when you invest in an equity, that is what you need to do. That takes long and serious study. John Templeton set his own standards exceptionally high in this regard. For most of his life, he worked 12 hours a day for at least 6 days a week. All his employees knew that he would pack as much as possible into every working day. Jim Wood, who helped set up an investment counseling business for the Franklin Templeton Group following the sale of Templeton's fund business in 1992, recalls how serious, short, and intense meetings with the head of the organization invariably were. Templeton's diary was always filled with meetings, each one scheduled to the nearest minute. In his days as a fund manager, he invariably carried a set of research reports in his briefcase to fill in any time caused by delays while traveling. It was known that he kept a pair of pajamas behind the sofa in his office, just in case work kept him late there, as it often did. Well into his 80s, despite his many other commitments, he continued to review and challenge the work of his research team, noticing much and missing little. Because he always worked so hard himself, it made you feel that you would somehow be letting him down if you did not do so too, Wood recalls. His focus on research stands in contrast to the way that some other investment firms are managed. Far from employees being desperate to be analysts, in many firms the analyst position is typically viewed as an entry-level position with limited status. It is a role which, if you are to advance a career, you will soon want to leave behind for others. Few CEOs of the largest investment firms have recent experience of analyzing a stock, and some have never even attempted it. Yet for Templeton, to be doing analysis was the highest calling, and as such something that called for long hours and a relentless search for new and better information. The reason why hard work matters so much in investment is that the task is essentially unlimited. There will always be more companies to analyze, more details to assimilate, and more news and fundamental changes to a company's operating environment to understand. The investor does not have enough time in the day to do it all. At the same time, waiting for perfect information before making a buy or sell decision risks being left behind, as by then the market is more than likely to have incorporated the thrust of the analysis into the price of the shares. The role of the analyst is to put together enough pieces to perceive the overall picture and then to judge how much impact the missing pieces could have. It is a question of balancing risk and reward. If the picture is very clear and unlikely to change much, then the risk is low and a slightly higher price can be paid. If the picture is still hazy and the range of outcome is wide, then this is a higher risk proposition where investment may be inappropriate. Aggressively monitor your investments. Rule 9. If investing is about a long-term approach, does this mean that we buy and hold and then leave our investment in a dark room to grow? As Sir John frequently noted, the world is constantly changing. As a result, it is vital to monitor investments closely once they have been made. His view early in his career was simply that investments should be sold when they become expensive. His typical holding period, as we have seen, was 4 to 5 years. He recognized that it takes time for the value in a cheap stock to be reflected in a rising share price. He rarely caught cheap stocks exactly at the bottom of their pricing cycle. Quite often, a company's shares might fall 25 to 30% after he first acquired a holding. That did not bother him. If his analysis was right, the performance would follow eventually. If the analysis turned out to be wrong, however, the stock should be sold. Some investors proudly declare that they never sell investments in good companies. This was not Templeton's opinion. Just as any company could become cheap, so any company could become expensive, and therefore cease to be a sensible investment. Later in his career, Templeton evolved a rule that a stock should typically be sold if another stock could be found that was at least 50% cheaper on fundamental grounds. The important thing was to keep the portfolio under regular review and be prepared to take decisive action when market conditions created new opportunities. The same discipline needed to be applied to selling as to buying. The reason was, he liked to say, when sentiment changes. It changes very suddenly, and if you are not invested, you will miss out on a large proportion of the returns. Although the focus on finding bargains remains constant, having a long-term investment horizon also requires the investor to watch out for broader changes in the world. The technology sector provides the most obvious examples of rapid evolution. In the 1970s, there was much talk about centralized computing, with huge mainframes being used to distribute computing power to dumb terminals. By the 1990s, all the companies whose share prices had soared on this expectation were dropping like stones, as the rise of the personal computer now had the opposite effect of decentralizing computing power. Today, the centralized model has again gained traction, with cloud computing becoming a hot area for investors. Big changes have also been taking place in the global balance of power. In less than 40 years, for example, the United States has moved from being the world's largest creditor nation to becoming its largest debtor. The biggest incremental purchasers of luxury goods are now in the East rather than the West. Commodities have gone from being scarce to being abundant and are now scarce once more. Such changes are not themes that the investor should be trading, but they will inevitably have a bearing on the earnings potential of individual companies, and as such, they need to be monitored. Don't panic. Rule 10. The corollary to selling stocks when they are expensive is to buy them when they are cheap. Rule 4. In John Templeton's words, the time to sell is before a crash, not afterwards. If you have been caught by a sharp market decline, then if there were good reasons to have held the stocks before the crash, there should be even better ones afterward. That means, he continues, the only reason to sell them now is to buy other more attractive stocks. If you can't find more attractive stocks, hold on to what you have. This rule is a perfect example of Templeton's simple but remorseless logic. One of his favorite techniques was to determine a price at which he would be willing to buy a range of stocks and leave those orders with a broker to execute should the prices of those stocks fall to the level at which he regarded them as cheap on a 5-year view. That way he could be sure that his decisions would not be influenced by an emotional response to sudden sharp movements in the market, and he would be buying when others were gripped by panic. While it may appear trite to say that the time to sell stocks is before a crash, doing so is psychologically difficult. The time to sell a stock is when it is expensive. The problem is that there is a reasonable chance that it will become more expensive. Indeed, this is the whole principle of momentum investing. The Templeton investor has to be prepared to watch a stock that has been sold continue to go up, often for some considerable time, and possibly alongside another recently purchased stock that is going down. One of Templeton's most frequent experiences was to see his bargains become cheaper after he had first bought them. Since his methodology was rooted in valuation rather than sentiment, he rarely caught the precise lows of any stock he bought and frequently sold too soon. By the same token, he often sold out of positions on the grounds that they were overvalued long before the market itself corrected to a more sensible level. His decision to sell out of the Japanese market in the early 1980s, at least 10 years before the Japanese market finally peaked, was by no means the only example of this phenomenon. The payoff to this rigorous valuation discipline comes, however, when markets experience one of their periodic blow-offs. It is no accident, as we have seen, that the key to Templeton's long-term outperformance of the market was his superior performance during bear markets. Not only is a portfolio of cheap stocks almost bound to fare better than one built around momentum in such periods, but the discipline of selling when stocks become expensive results in the investor having cash to invest when prices in an overvalued market fall sharply and indiscriminately, creating new opportunities. Sir John's investment discipline in this respect was critical in helping to create his track record. It was a lesson that, as we have seen, he regularly imparted to his clients as an investment counselor, and one that time and again he put into practice during his career as a fund manager. As a fund manager, there were several occasions on which he moved a significant proportion of his portfolio into cash and bonds because stock values had risen too far and he was no longer able to find sufficient bargains. To be in that position requires not just analytical skills, to know when a market has become expensive, but great strength of character to ensure that the discipline is not abandoned when the market does subsequently fall sharply. The same thinking lay behind the use of the Yale formula in his days as an investment counselor. Buying when others are despondently selling, and selling when others are greedily buying, to quote one of his favorite maxims, requires the greatest fortitude, even while offering the greatest reward. One of the central exhibits in any Templeton investor's armory is the evidence of how the stock market reacts to traumatic events, such as the 1929 and 1987 market crashes, or external shocks such as the 9/11 terrorist attacks on New York and Washington. What is striking from this analysis is how an immediate, panicky reaction to the event is often taken to unwarranted extremes as investors race for cover. The market often recovers well within a number of weeks, typically regaining a good deal of the previous loss. As selling in crisis periods can be indiscriminate, stocks often get beaten down across the board. For a disciplined investor, with rigorous valuation criteria, this creates the opportunity for profitable participation in the subsequent recovery. Learn from your mistakes. Rule 11. Investment analysis is an evolutionary process because the world itself is constantly evolving, and it takes time to gain the necessary experience and historical perspective to learn how to assess absolute value in stocks and how the corporate environment is likely to impact the future earnings potential of companies. Anyone who worked for Templeton was aware of his constant search for new insights into the way the world was evolving. Nothing was more important in his view than to study and to understand why reality so often turns out to be different from what faulty analysis expects. Hindsight is a wonderful teacher, but in many investment organizations the need to learn lessons is frequently lost in a hunt for scapegoats to blame when things go wrong. This was not Templeton's way. He was his own taskmaster. While working for the company in the 1990s, for example, one of the authors observed firsthand how much effort Templeton put into trying to work out whether he was wrong to have dumped his Japanese stocks as early as he did, a decision which, as we have seen, led to one of his longest periods of relative underperformance. This was only one of many examples of how Templeton sought to learn from his own mistakes. It is also another way of saying that having the right investment philosophy is not itself sufficient to guarantee success, as many how-to investment books effortlessly imply. Implementation is the key, and while setting out to buy low and sell high is simple, it is not easy to do. Begin with a prayer. Rule 12. Sir John used to start meetings with a prayer. Even for those who are not of a religious disposition, there was nothing to object to in the words he spoke. All that he asked for was to be able to work to the best of his ability to help his clients. We don't pray that a particular stock we bought yesterday will go up in price today, because that just doesn't work, he told his biographer, William Proctor. But we do pray that the decisions we make today will be wise decisions, and that our talks about different stocks will be wise talks. If nothing else, opening with a prayer helped him to create an atmosphere that was conducive to the kind of calm and deliberate analysis that he held to be essential to good investment decision-making. Many of his colleagues recall finding themselves motivated to work harder for fear of failing to live up to their employer's own, much higher personal standards. Outperforming the market is difficult. Rule 13. Although his own track record as an advisor and fund manager was proof that it could be done, by the time of the sale of his fund management business to Franklin, John Templeton was well aware of the difficulties both individual investors and fund managers face in seeking to outperform the market on a sustained basis. As an investment counselor in the 1950s, it was natural, and indeed orthodox, to claim that his firm's use of the Yale method, allied to successful stock picking, was capable of producing better-than-average results for his clients. The marketing materials of the Templeton Growth Fund from the 1970s onward made extensive use of his track record to promote sales of his fund. It was not until this period that the first academic studies of mutual fund performance began to expose how hard in practice it had become for professional fund managers and advisors to outperform broad market indexes over anything but relatively short periods. This discovery led in turn to the launch of the first index funds and the appearance of a new industry of consultants and other intermediaries whose sole job was to analyze and rank professional investment performance, not just in absolute, but also relative terms. In the 30 years between 1960 and 1990, the stock market moved from being a market dominated by individual investors to one dominated by large investment institutions, such as pension funds, insurance companies, and mutual funds. The abolition of expensive fixed commissions in 1973 in the United States and 1986 in the United Kingdom, coupled with rapid improvements in information technology, globalization, and the arrival of derivatives, was meanwhile prompting a quite remarkable increase in both the volume of trading and the degree of competition in international securities markets. When Templeton first outlined his investment maxims, in the early 1980s, there was little mention of the difficulty of beating the market. By the 1990s, however, it was no longer possible to dispute the fact, which had become extensively chronicled in academic and professional research. To admit as much was therefore doing no more than accepting a basic fact of life that now confronts all investors, both professional and private. Toward the end of his life, John Templeton himself said that he doubted whether he would now be able to produce the results he did in his heyday as a fund manager, given the greater degree of competition across the industry and the increasing pressures faced by fund managers to produce short-term results and conform to consensus thinking. As a businessman, while he remained confident that his investment philosophy remained as valid as ever, he was very conscious that the investing environment had also changed, making it harder for professionally managed funds to outperform the market as dramatically over the long run as he had been able to do. While he was clear that index funds could never produce as good results as the best active investors, he was equally careful not to say that they did not have their uses. In an interesting memo to his colleague Mark Holowesko, written in 1993, soon after the sale of his business to the Franklin Group, he underlined some of the implications that the new environment had for a fund management business. He argued that it made sense for the firm to offer a range of funds that each had different allocations to equities. Why? Firstly, it enables the dealers to offer to the public at all times some kind of fund which fits the wishes of the public. Secondly, it multiplies the chances that one or two or more of the Templeton funds will be at the top of the performance table at different times and thereby attract vast, free, favorable publicity. A similar argument applied to the question of whether funds or portfolios should be split between different managers. Templeton's clear view was that there should always be one lead manager for every fund, as this would increase the diversity of the firm's offerings and thereby multiply the chances that one or two or more of the Templeton funds can be at the top of the performance list in all varieties of market conditions and fashions. For all his high principles, he was nothing if not pragmatic as well. Success is a process of continually seeking answers to new questions. Rule 14. There is not much to add to Sir John's comments on this. An investor who has all the answers doesn't even understand all the questions. A cocksure approach to investing will lead, probably sooner rather than later, to disappointment, if not outright disaster. Even if we can identify an unchanging handful of principles, we cannot apply these rules to an unchanging universe of investments or an unchanging economic or political environment. Everything is in a constant state of change, and the wise investor recognizes that success is a process of continually seeking answers to new questions. As we have seen, this is an axiom that he himself continued to observe right up to the end of his life. The conditions that prevailed in the first decade of the 21st century were very different than those of the 1940s or 1950s. New industries, such as computing, inevitably required new methods of analysis. At the same time, styles of investment also come and go. There are periods when large stocks do better than small stocks, and vice versa. The same goes for value and growth. It was central to Templeton's view of the world that the investor had to adapt accordingly. The relevant maxim here is, if a particular industry or type of security becomes popular with investors, that popularity will always prove temporary, and once lost, won't return for many years. It is the nature of the investment business that it has a constant need for new ideas or instruments that it can market, and investors need to be vigilant in order not to fall into the easy trap of following fads. There is no free lunch. Rule 15. This has become a common saying in financial markets, and is a principle that underpins a good deal of modern regulation of financial markets. Investors rarely get something for nothing, even if they are unsure or unaware of what the cost is at the time. The saying is allied to the notion, well documented in research, that in general there is an inverse correlation between risk and return. The higher the risk of an investment, the greater the return that investors will require by way of compensation for owning it. A central tenet of modern portfolio theory is that diversification is one of the few free lunches in investment, as a portfolio of negatively correlated investments will reduce the volatility of the portfolio without necessarily reducing the return. Templeton's comment on this was laconic. Everyone should read about modern portfolio theory, but honestly they are not going to make much money with it. I've never seen anybody that came up with a really superior long-term record using only modern portfolio management. His point here was not that diversification was wrong, but that the notion that building portfolios on the basis of unreliable and irrelevant statistical inputs, such as historical volatility, was doomed to failure. He was always at pains to impress on his colleagues the need to avoid allowing their implicit or explicit biases to influence how they invested. In his view, there were no shortcuts. Proximity to a company, analyst recommendations, tips from friends, use of its products, all these are terrible reasons to buy a share. Investments should only be made, in his view, after extensive due diligence. Be positive. Rule 16. Virtually every speech ever made by John Templeton focused on the positives of life, and he wrote a series of books encouraging others to share this philosophy in the way they organized their lives. His speeches would document the great advances in literacy, modern medicine, living standards, and mortality rates that had been achieved in his lifetime. He had great faith in the ability of mankind to triumph over adversity, but worried about how many people seemed prone to negativity. When a friend of his launched a new newspaper to counter the media's obsession with bad news, it lasted less than 3 months, an outcome that he regarded as a sad reflection on human priorities. This carried over directly into his approach to investment. He had huge faith in the power of human ingenuity if protected by the law of property rights. He believed economic progress had been accelerating since the Industrial Revolution, and that it was a paradox of the human psyche that we could simultaneously remain gloomy about prospects while simultaneously enjoying the benefits and fruits of that progress. Any investor who reads the rules or the maxims that John Templeton laid down is bound to be struck by their simplicity. They are not difficult to understand. He himself referred to investment as being, for the most part, common sense. In the first chapter, we noted how his colleagues invariably allude to the way that he was able to make complex issues seem so straightforward. The fact that so many of his maxims remain relevant despite first being coined more than half a century ago is a testament to the power and timelessness of his insights. Yet there is no evidence that we can see that they are any more widely observed today than they were in his time. The increasingly short-term focus of modern professional investment stands in diametric opposition to the principles and approach that John Templeton both preached and practiced. Modern portfolio theory has failed, on the whole, just as he predicted, to produce consistently superior results. The explosion of information made possible by the Internet and instant global communications has empowered, but not yet enriched, private investors. The opportunities to profit from a Templeton approach to the markets are therefore just as great today as they were in the past, but the task of putting them into practice is no easier.